Everyone, Namaskara. Hearty welcome to Jnanarjane, Empowering Excellence. Friends, we stepped into day 2 of 3 days transfer pricing workshop. Yesterday, we had a fabulous session from 3 eminent speakers, CA Rishi Halaka, Advocate Manonit Dalal, and Advocate Jnana Prakash Srivasa. Today, we have another interesting sessions from another 3 eminent speakers, CA Ganesh Krishnamurty, CA Faaizah, Fathima, and CA Hiranmayi Ganesh. All three are eminent experts having vast experience in transfer pricing, international taxation. We are really fortunate to have them here. On behalf of Bangalore branch and on behalf of all the participants here, hearty welcome to CA Ganesh Krishnamurty. Hearty welcome, Ganesh. Hearty welcome to CA Faaizah Fatima. Hearty welcome, ma'am. Hearty welcome to CA Hiranmayi Ganesh. Hearty welcome, Hiranmayi.
Thank you, sir.
Friends, you are the reason for this program. Your overwhelming response for all the Bangalore branch program. That is the reason we organized this very, very interesting and apt topic, transfer pricing in detail for 3 days, 9 hours of learning. Even for the beginners, it's a good move. That is the reason we organized this program. Hearty welcome to each one of you. I'll take a minute of yours to inform about some of the upcoming programs. On 9th of September, 9th and 11th, 2 days session we have organized on private trust. Private trust, after completing the succession planning workshop for 3 days, we thought it have to have this private trust session in detail for 2 days, 6 hours learning. And it is an important area of learning for succession planning. That is the reason we organized this on 9th and 11th of this month, 4 to 7 p.m. virtual program. I request all of you to register that. It's a very, very interesting area. Bangalore is a happening city. Lot many succession planning opportunities are available for all the members, those who are interested in that. I request either you yourself join or inform your friends and colleagues about this program. Friends, on 16th to 19th, 3 days we have organized information technology workshop. Many interesting new things you can learn from that workshop. I request all of you to register to that program too. And I request please visit bangaloreici.org. More than 18 programs lined up for this month. So I request all of you to visit bangaloreici.org regularly and register for all the programs so that you can learn many new things. Things are changing very fast. So many traditional practices may go away. So we need to look for other newer areas. When the economy is growing, the opportunities are plenty. In that regard, your branch is conducting many new areas of practice for the benefit of our practicing members and industry members too. They can also learn many new things to update themselves for the benefit of their career. With that note, please visit bangaloreici.org regularly so that you will come to know all the happenings in Bangalore branch. With that note, once again, hearty welcome to each one of you. Hearty welcome to Bangalore Branch Secretary, C.A. Divya. Over to you.
Thank you so much, Chairman. A very pleasant good evening to all the participants and to all 3 eminent speakers of today's program. Indeed, it's my pleasure to give brief introduction about today's speakers. We have with us Mr. Ganesh Krishnamurty, who is Director with the Tax and Regulatory Practice of PwC and has over 16 years of experience in assisting global and Indian MNCs on tax transfer, price value chain, planning, structuring, audits, litigation, and competent authority processes. He is Commerce graduate and a fellow member of ICA. With this very brief introduction, I wholeheartedly welcome to you for today's program, sir. Hearty welcome to you.
Thank you.
We have Ms. Hiranmayi Ganesh, who is a member of Institute of Chartered Accountants of India and also BCom graduate. She has working experience in assisting various multinationals in transfer pricing compliances, including benchmarking, value chain analysis, advisory assignments, audits, and litigation across automotive, manufacturing, and many other sectors. With this brief introduction, I welcome you also, ma'am, for today's program. Hearty welcome to you. Members, we also have Ms. Faaizah Fathima with us, who has experience in assisting various MNCs in transfer pricing compliances, including value chain analysis, benchmarking and advisory assignments, including COVID analysis across logistics, manufacturing, IT sectors. She is also a member of IC and BCom graduate. With this brief introduction, I also welcome you, ma'am, for today's program.
Thank you.
Thank you. Over to you, ma'am.
Thank you, Ms. Divya, for this kind introduction, and thank you, Mr. Shetty, for giving us the platform. And we feel privileged to be amongst fellow members to talk about this important topic today. And we also duly acknowledge the efforts that ICAI is doing with reaching out to members on such important topics. And I feel privileged as a fellow member to share our knowledge and experience with other fellow members. So thank you for this opportunity, and we really appreciate that. So today, as a continuation of the sessions from yesterday, yesterday, for example, we reflected, our speakers, our eminent speakers reflected on the various aspects of documenting functional analysis, selecting most appropriate methods in a transfer pricing analysis. Typically, as we know and as we have understood transfer pricing as a subject, it is a provision under the income tax law, as we know, under Chapter 10 of the Income Tax Act 1961. At the same time, the most interesting part of this legislation is it is intricately connected with business, on how a business is run, on how a business makes income, and how the income is offered to tax in the jurisdiction in which the activities are undertaken. And therefore, in that context, a transfer pricing analysis, there is no one way to do it. Of course, the legislation is very helpful as a guidance. What we'll do today is to share some practical aspects of how this law is implemented or put in practice, if I may say so. So my colleagues along with me today, Ms. Hiranmayi and Ms. Faaizah, we'll go through some of these examples, and we've tried to make it as easy as possible in terms of supporting it with examples. We do some case studies. And what we'll try to cover in the next 3 hours of this time that is allotted to us is we will talk about the various methods and how they are applied. So for example, yesterday's session, we learned about the method. So we will not go through the methods again. We assume that the participants have understood, at least broadly have an understanding of the methods. What we will do is we will try to help go through the methods, how they are applied, how is the arm's length price determined? Because at the end of the day, in the next 1 month or a few months, we will all be in a situation where we will have to sign off certificates for our taxpayers who have, say, international transactions or transactions subjected to transfer pricing. And we will have a task before us to walk the talk. By walk the talk, I mean, whatever we are learning today, whatever methods we're learning, how do we certify that that is arm's length? How do we certify that the transactions are arm's length? And that's what we will do in the next few minutes. We'll go through examples of pricing methods. And after we do that, just for the benefit of the audience, we will also go through certain approaches that are prevailing in terms of doing a search process. A search process because the search process would enable us to determine an arm's length price. And we will go through examples to help us understand how the methods are applied. And finally, a specific element of a business or transactions, which we are seeing increasingly prevalent in today's world, are financial transactions. And this is very complex because financial transactions are inherently built on complex assumptions. So we will go through what are the different types of financial transactions that we see in the environment around us, and where does transfer pricing play a role in it. So these are the 3 elements we will cover in the next 3 hours that are allotted to us. And I look forward to an interactive session with all of you. If you have any questions, you could post it on the chat box that is available, and we will take up the questions as we progress or at the end of each topic that is assigned to us. So with that, I hand over the session to my fellow colleague Hiranmayi, who will take up the first topic. Over to you, Hiranmayi.
Thanks, Ganesh. Good evening, everybody. So the first topic for today is computation of ALP, where we'll just be quickly covering 92C along with 10B and 10C as well. So the broad agenda will be what transfer pricing analysis is all about, why at all the transfer pricing concept came in, and how relevant is the arm's length principle, the different methods that are in use, and a little illustration for each of the methods, and some sample illustrations for the Rule 10CA. So first of all, I would like to talk about why transfer pricing became relevant, or how the arm's length principle itself became relevant in the first place. I'll give you a small example. It's a hypothetical situation where, say, you want a personal loan, and you're going and asking any one of your relatives for a loan. You can sort of negotiate with them and ask them for a lower interest rate, or even without an interest. Whereas if you want that same personal loan, when you go to a bank, you cannot negotiate terms with them. They will look at your credit, your credibility, whether you will be able to repay that loan, and they will charge a standard interest rate that they have as per their norms. So you will not be able to negotiate in that situation. So in a related party transaction, you have this inherent advantage. That is what I wanted to drive down here. So when we have an inherent advantage in a particular transaction, which an uncontrolled transaction will not have. For example, we may have advantages such as some price concessions, or extended credit periods that the related entity might give you, or reduced interest rates, or reduction in logistics expenses, etc. So because of this, many multinationals tend to exploit these benefits and exploit tax positions. So for example, by increasing the purchase price of goods from a related party, this entity will be able to reduce the tax profits in one particular jurisdiction. Another example would be, say one associated enterprise is in a country which has a high tax regime, say at a 35%. There is another associated enterprise in a tax-free country, or in a country which has lower tax regime. They'll be able to manage their profits in such a way that more profits are sitting in a place where there is a lower tax. So in order to prevent all of this and to promote this competitiveness and the international trade, the entire concept of arm's length principle came in. And because of this, we go through the transfer pricing analysis. In the transfer pricing analysis, I just want to give you a quick snapshot of what happens up to the transfer pricing selection of the transfer pricing method and comparability. First, we have the group and industry overview. If I can take an example here, there will be, let me take the example of COVID itself. So in COVID, we find that certain sectors have been more resilient to the COVID impact. Say ITS sector, the entertainment sector, or the gaming sector, for example, or online education sector, which has actually been resilient to COVID impact, whereas the airline sector or a core manufacture sector has been affected, and auto sector has been affected. So we'll have to look into the group and the industry overview before we can undertake the comparability analysis. Next, we have the functions, assets, and risks. So basically, the entire concept of transfer pricing revolves around this, because each country which is undertaking the functions, assets, and risks should be, the profitability should be attributable based on the functions, risks, and assets that are employed by each entity in each jurisdiction. So what are the functions that are taken by different enterprises? What sort of risks are taken by each of the enterprise? Because higher the risk taking entity, higher the profitability should be attributed to that particular jurisdiction. So based on the FAR analysis, we will have to attribute the profits. Based on the FAR analysis also, we get to the characterization. In characterization, there are different business models. An entity could be a full-fledged manufacturer. It could be a licensed manufacturer, it could be a contract manufacturer, it could be a toll manufacturer. There are different business models. So we'll have to characterize the transactions, characterize the entities based on the FAR analysis. Next, based on the characterization, we select the tested party. The tested party usually is the least complex entity, which is taking the least risks, least functions and assets, so that it is easy for comparability. Finally, after crossing all these stages, we go to the TP method, and that is the most appropriate method is what we call it, and then comparability aspects. I'll move on. So basically, arm's length price is something which is determined by market forces. So there should be no influence of any one entity with the other. It has to be purely based on demand and supply, right? That is the market forces. So if we look at section 92F of the Income Tax Act, it says arm's length price means a price which is applied or proposed to be applied in a transaction between persons other than associated enterprises. So associated enterprises are related parties, in simple words, and uncontrolled transactions where you don't have any kind of influence over the pricing by some other entity. One entity's pricing is not influenced by the other entity's pricing. That is an uncontrolled kind of a scenario. Now, let us look at what is the significance of this principle, why it has come into picture, and what are the difficulties which are there in application of this principle. First one would be parity. So parity between MNCs and independent enterprises, this is nothing but when comparing the transactions, right? Each entity should have an equal footing. It becomes unfair when one entity can take more advantages. I was talking about, right, when there's an inherent advantage for one entity, whereas the other entity does not have that advantage, then it's not fair for a competitiveness sake. Also, because we look at always the market forces of demand and supply, because or else it will distort competitive positions of each individual enterprise in the market. Also, because of this ALP concept, it will promote international trade and it will stop this distortion because it is determined by the market forces. The next one is determining real taxable profits. Like I told you, right, the functional analysis needs to be done for each of the transaction, which entity is contributing to what part of the profitability and what are the functions undertaken. So based on which we'll be able to determine the real profits that are attributable to each jurisdiction. The next one is reduction in artificial price distortion. If I take an example here, we may sell goods, right? When in a related party kind of a scenario, one associate enterprise might sell goods at a higher price to a higher tax regime, where there's a higher tax regime, higher than the market prices, and at a lower price in places where there's a lower tax regime, lower than the market price, because of which the competitive advantage is lost here and there's a distortion in the market. Then obviously there's a minimization of double taxation. So what happens is this arm's length principle concept, since it's an international concept, when if at all there's an adjustment towards this transfer pricing in one jurisdiction, the other jurisdiction wherever the counterpart should also take that adjustment. One example I can give you here is MAP. We have mutual agreement procedures also in India to ensure this double taxation kind of a scenario is avoided. Then we have accurate measure of economic contribution. Like I said, because it is being attributed due to the market forces, we can ensure, because of this arm's length principle, that each jurisdiction gets the relevant profits that it ensures income. It ensures that the income is attributed to wherever that particular income is earned. Now, when we look at practical difficulties in application of an ALP, so in some cases, there will be a difficulty in comparison. This arises when, in case of a highly unique intangible or an intangible where there is high sensitivity involved. For example, there could be a secret formula for a particular product, say a drink, or some secret formula for, or some secret procedure or some secret process which cannot be revealed outside, wherein the entity will prefer to have that secret within the group itself, and they'll not be willing to share it with the third party. In that cases, you will not find a proper comparison. Next one is availability and reliability of data. Sometimes data for comparison will be incomplete or it will be difficult to interpret. There are also geographical constraints. For example, in case when we need some data from our counterpart or an associate enterprise outside of India, sometimes it might be difficult to get that information from them. There are a lot of confidentiality and secrecy aspects as well, wherein the associated enterprises where we want the information from them will not be able to get for a comparability. Then again, in case of an intangible transaction, it will be difficult to find a comparable because intangible will be so unique for a particular entity that it will be difficult to find a comparison. Absence of market price. This is where sometimes you will not get one fixed price. It will just be a range or it will be a very wide range. So it will be difficult to determine the exact comparable. Next, absence of comparable market for intangibles. Like I said, right? In case of intangibles, it's very difficult to find the exact match or exact comparison. Administration burden. This comes wherein every tax administration or jurisdiction will have to evaluate each and every transaction that the taxpayer is entering into to check whether it is consistent with the arm's length principle. So it creates a lot of admin burden and time lag. So what happens is, for example, this year an entity is entering into a transaction. A couple of years down the line, it will come into the purview of the tax administrators. And when it comes to them, what will happen is there might be some commercial or some business reality or some reason for an exceptional loss, for example, which happened at the time of transaction. But the same information will not be available with the tax administrators at the point when they are evaluating. And because of this time lag, the tax administration might not really appreciate what we are trying to say or how we are trying to prove that a particular transaction is within arm's length. Yeah. Ganesh, is there something you'd like to add here or
Yeah, I would only say that, I would only add that the arm's length price as a concept is very subjective. And for each of us as professionals, when we look at our own taxpayers on how do we substantiate arm's length, there is, of course, there is a lot of interplay that transfer pricing as a law can also have with other regulations. Although what is important is to justify the price being arm's length based on hard data, but we could also, benefit from the information that may be submitted to other regulators, for example, the GST purposes or customs data, etc. So when we approach an arm's length price, we should be having an open mind, because there is, as my colleague Hiranmayi highlighted, there are a lot of difficulties which the administrators also understand. It is not that it is one-sided. Because this law has been there with us for 20 years now. So there we have gone through, as a country, gone through several amounts of litigation in this matter. And therefore, today, as we stand, there are various sources of information for determining arm's length price, which we will cover in the subsequent slides. But while this slide indicates there are difficulties, but I don't want to leave a pessimistic note here. I would say these difficulties can certainly be overcome, and we will go through some ways to do it. Over to you, Hiranmayi.
Absolutely. Yeah. So, like I said earlier, these are the various steps that we need to, go through before we can actually determine an arm's length price. So first, we'll have to identify that there is, in fact, an international transaction or a specified domestic transaction. Then we'll have to look into the FAR analysis, which is nothing but the functions, assets, and risks that each taxpayer or in each enterprise and its associated enterprise are performing. Then we get to decide, we should be deciding on the characterization of the entity and tested party, which is of course the least complex entity. Then based on all these factors, we come to ascertaining the most appropriate method, and based on which we can arrive at the arm's length price. I'll move on. Yeah. So when we look at section 92C of Income Tax Act, it talks about the arm's length price in relation to an international transaction or specified domestic transaction shall be determined by way of the most appropriate method. So right now we have 5 definitive methods and one method, the other method. We have a comparable uncontrolled price method or CUP, resale price method or RPM, cost plus method or CPM, profit split method, and transactional net margin method. If you see the chart here in the right, CUP method, cost plus, and resale price method, they emphasize more on product comparability and similarity. Whereas profit split and transactional net margin method, they emphasize on more on the functional comparability. In these cases, not much of product comparability is essential. The first proviso talks about when more than one arm's length price is determined, we should be taking the arithmetic mean of those prices. And in case there's a variation between the arm's length price and the price which is charged by the tested party, a maximum of 3% is allowed as a difference. In case of a wholesale distributor, instead of 3, there is a 1%, which is allowed. 1% deviation is allowed. If we are within the deviation limit, we are still said to be within arm's length. I'll move on. Yeah. Tested party, like I said, after determining the tested party, we'll have to choose the most appropriate method that will be applicable for the tested party based on the functional analysis, the FAR analysis, and tested party will be the least complex entity. And selection of time period, rule 10b5, what it says is, when selecting comparables, right, we'll have to select comparables which has data for the current financial year under consideration, and they immediately, if current financial year's data is not available, then the immediately preceding financial year's data can be considered as well. Now, with regard to comparability, what are the factors that we should be evaluating when we compare? When we look at that, the first point is distinctive nature of the property transferred or the services provided. To give you an example, for goods, we can look at physical features, the quality of the product, the availability or the volume in which we are supplying a product. To give you an example here, a particular branded product might be more relevant or more preferred compared to a unbranded product, even though it has the same kind of utility. Then for services, you'll have to check the nature and extent of services. In case of financial transactions, you'll have to look at what is the nature of the transaction. Say, for example, a loan. What is the nature of the loan? What is the duration of the loan? What is the purpose for which the loan is taken? And in case of intangibles, right, whether we are licensing the intangible or whether it is a sale, or what is the kind of property that is transferred, whether it is a patent or a trademark, what is the duration for which we have licensed that intangible, and what are the anticipated benefits that come out of the intangible. So these are various factors which need to be considered while we look at comparability. Next one is functions performed. So again, like I told earlier, where the economically significant activities are taking place. So because of what function or which function plays a more important role on the profitability of the product. So that needs to be taken into consideration. There are various functions. We have the production function, we have the strategic decision function, who takes the strategic decisions, who does the R&D for the R&D is research and development, who takes the research and development, who owns the IP, etc. will come into picture here. Majorly to evaluate on the characterization, whether it's a low risk taking entity. If it's a low risk taking entity, then the profitability should be to that extent reduced. And if it's a high risk taking entity, to that extent, a higher profitability should be attributable to that entity. The next point will be the risks assumed for the particular thing. So risks, we have a couple of risks that we look into. We have financial risks, we have product risks, we have market risks, we have credit risks, and we have foreign exchange risks and capacity risks. Financial risks can be, for example, in case there is a loss, who is going to fund for that? What is going to be the method of funding? What is going to be the contribution, capital contribution? And for product risk, who's going to take care of the research and development? Who's going to take care of the product development? In case of technology sector, there is huge obsolescence, right? So who's going to take care of that? Who's going to take care of the product warranty risks, etc., for replacements and after sale services, for example? And market risks. Who's going to take care of risk where there's a reduction in business volumes because of various factors? Who's going to take that risk? And because of demand fluctuations. Credit risk talks about who's going to take care of the bad debts, risk of bad debts. In case a customer is not paying up, who's going to take care of that risk? When we talk about credit risk, yeah, I just spoke about credit risk. Then we have forex risks. In multinationals, it's inevitable that we have foreign exchange fluctuations between countries. So who will be bearing that risk? And capacity utilization risk is when there is an underutilized capacity. Even now in the COVID scenario, a lot of manufacturing entities have a lot of underutilized capacity, at least for the period of lockdown. So who's going to be bearing that risk? That could be a question as well. And market conditions. For market conditions, we have the geographical location, size, and cost of labor and capital. Like especially now, a lot of multinationals are wanting to set up their enterprises here in India or even in China for that matter, because we have good quality resources at low prices. And that's why they would, for economies of scale as well, they'll want to come in. So the cost of labor and capital also plays a role. The regulatory laws, how stringent or how flexible the laws are, and the level of competition in a particular market as well. So these are various conditions that we'll have to look into when we are comparing various transactions. Now we go into the most appropriate method. So like I mentioned, there are three basic traditional methods, transactional methods: the CUP, RPM, and CPM. Transactional profit methods based on profitability, profit split, and Tnm. And we have the other method. Again, while applying this most appropriate methods, we'll have to look into the strengths and weaknesses of each method. So basically, again, choosing a most appropriate method is a very fact-incentive or fact-sensitive kind of an exercise. So you cannot equate one situation to another situation. We'll have to look deep into each case and understand what are the facts and circumstances of each case, and then decide on the most appropriate method. And again, the various criteria like the functionals and availability of reliable information for each of the cases, the degree of comparability and reliability of comparable adjustments need to be taken into consideration before we can select the most appropriate method. First, we go to the CUP method. So the chart towards the left is basically the rule 10b, which talks about how each method is to be applied. For comparable uncontrolled price method, it's usually applicable when similar transactions are undertaken between unrelated parties. It has to be unrelated parties. So first, as a first step, what we have to do is, what is the price charged in a comparable uncontrolled kind of a situation? And then we'll have to adjust for any differences in the open market that would affect in the open market, such as terms of contract, credit period, and transportation costs. I'll elaborate on this. When we adjust for these differences, we will get the arm's length price. So typically in transfer of goods, provision of services, intangibles, and interest on loans, CUP can be used. But again, when we apply a CUP, right, high degree of product comparability is required. So other adjustment areas or places or aspects that we need to look into before doing a comparability analysis or before choosing CUP as a method are type and quality of products. Like I told you earlier, right, a branded product cannot be compared with an unbranded product. A branded coffee, for example, cannot be compared with an unbranded coffee bean. Even though it has the same utility, same taste, etc., it cannot be compared. Terms of delivery, for example, the differences in terms of delivery, it should be measurable and it should be reliable as well. The third point is volume of sales and related discounts. So in case of a related party scenario, there might be a lot of advantages within the group, right? There might be advantages like savings in logistics costs. And so therefore, there'll be a lot of economies of scale and volume related discounts, which might not be prevalent in a unrelated party kind of a scenario. Then we have product characteristics. To give you an example here, in a related party kind of a scenario, a related party might require you to customize a product based on the related party specification, right? The same product you might sell to a third party, but it might not be comparable because of the customization. Then we have contractual terms. Contractual terms, you can say, for example, the payment terms. Say, for example, to a related party, you give a credit period of 90 days. Whereas to an unrelated party, you follow a system of cash on delivery. Like on delivery, you have to pay immediately. So these kind of scenarios, when the terms are different, these transactions will not become comparable. They cannot be compared. Or reliable adjustments need to be made before you can compare the transactions. Risk, for example, when there is an inventory risk, or when the party is undertaking customer defaults, whereas in a independent transaction, in a related party transaction, the associate enterprise might be taking that inventory risk, whereas in an unrelated transaction, the particular enterprise itself will be taking that kind of risk. So the adjustments for risk also need to be taken care of. And geographical factors. A demand for a particular product might be more in one geography when compared to another geography. To just give you a quick example, in India, when you're selling cars in India, the BS6 regulations have become mandatory. So without following that, you cannot, sell cars here. So based on the geographical factors also, we'll have to make comparisons. Ganesh, would you like to add anything here, or shall I move on, Ganesh?
Yeah, so I think you covered the important points. I would only say that there is a lot of guidance available in, of course, the Income Tax Act and rules are very limited. I mean, they explain the methods in the way it has to be applied. But we do have, as a country, we do have benefit of several rulings that have been pronounced on these matters. That's one. Internationally, there is guidance from the OECD as well as the UN on the applicability of these methods, the practical challenges, and the comparability parameters. Typically, we've seen in practice the CUP method being applied in cases of mostly in cases of intangibles and financial transactions, because the data relating to that those transactions are so unique, and they are also publicly available through various databases, for example, and therefore typically in these two categories you see the CUP method being applied. We've also interestingly seen a lot of examples of the method being applied even for imports, where we have price data for goods for customs purposes, which has been submitted. And that also comes handy because the transaction that has happened with respect to similar imports from related parties happens around the same time. So the timing lag of data is avoided through that purpose. But that does cast an administrative burden to collate that information on a regular basis. So that is something, as professionals, we'll have to weigh the benefit of applying this method vis-a-vis the administrative burden of collating this data. But even where you get the data available, these adjustments that have been spelled out by my fellow colleague, that is something that we'll have to invest a lot of time, because it's not very straightforward. Because I think certain things you can do an adjustment, for example, a credit period adjustment. It's not difficult because you can estimate a finance cost for the credit period and do an adjustment to the profit margin. But things like terms of delivery, if it's a CIF versus FOB, etc., that's something which one has to see on a transaction by transaction basis. So a difficult method to apply in practice, but if we have the data available, then certainly more specific and more reliable. Over to you, Hiranmayi.
Thanks, Ganesh. So CUP can be an internal CUP or an external CUP. A simple example here, A1, Associate Enterprise 1 and 2, they are entering into a transaction. The same transaction is being entered into with an unrelated party. So this becomes an internal CUP. Similarly, party A and AE2 are entering into a transaction, and that becomes comparable with the controlled transaction. So the dotted line represents the uncontrolled transaction, and this is the controlled transaction between the associate enterprise 1 and associate enterprise 2. An external cup is when the transaction entered between the related parties, the same transaction, same facts and circumstances are happening in another transaction between two completely unrelated parties. That becomes an external couple. There's one more illustration. For example, there's a manufacturer in US who's outsourcing his manufacturing to India and to its AE in India and also to an unrelated party in India. So this can be taken as a cup. Again, in second illustration is in case of an exporter of aluminium, he's exporting it to an AE in US for manufacture and also to an unrelated party. This can also be taken as a comparable.
The only caveat I would add is we'll have to, of course, verify that the volumes and the various other terms to the transactions are comparable. But assuming those are all comparable, this is definitely something which indicates a potential cup available to the business.
Yeah. Some practical issues that we might face while applying the cup, like I told you, a unique or a valuable trademark. One particular entity might claim that it has the most unique intangible and there's no intangible out there which is comparable. So in that case, it becomes difficult to compare using a cup. And cup will not be applicable when there is a fundamental product difference. Like I told you, product comparability is very important. Product similarity is very important while applying a cup. Again, getting an identical transaction because of the various factors I mentioned earlier, like volume, contractual terms, terms of delivery, geography, who is going to be the end user of the products or the services. Obtaining an identical transaction could be difficult. Or making a reliable or an accurate adjustment, like Ganesh was just mentioning, for few aspects, it will not be feasible to, or it will not be reliable to make a proper adjustment or an accurate adjustment which can be comparable. Then the next one is indirect evidences of cup. Can data from public exchanges or quotations be used? So data from public exchanges can be used in my view because again, when we spoke about the concept of arm's length price, right? We spoke about the market forces of demand and supply. So in a public exchange kind of a scenario, it's open to the market forces. So in my view, we can use the data from public exchanges. And quotations as such, they are not final fixed prices. So it's just a rough kind of a computation. So quotations cannot be used is my view. However, yeah, Ganesh, you have something to say here. Quotations cannot be used is my view because it's not a final fixed price. It's just a sort of like a draft which has been issued.
Yeah, and practically that is true in a way because the quotations are given on certain assumptions and it is not an actual transaction per se. And we will cover that when we come to financial transactions also because it's quite common to have quotations from banks or financial institutions. We could also have quotations from suppliers. So when we are, for example, importing a machinery, so if we are importing a machinery from, say, a group company, and in order to get an arm's length price for it, we also ask, say, a local organization which manufactures a similar machinery to give us a quotation. So we may get a quotation from the, say, a local vendor. But the question is whether that quotation is an actual price. Does it represent the similar machinery in a way that it is imported? So those are the checks we have to do. And finally, maybe it is possible that it may be a benchmark, but since it is not an actual purchase from the third party, The revenue authorities, our tax authorities may say that that is not an actual transaction, and therefore it is not a comparable uncontrolled price. So if we don't have any further way of justifying the imports, and this is our best data that we have, for example, because that is possible in a situation, we should also highlight to the taxpayer that depending on the materiality of the transaction, etc., this may be challenged by the authorities. So we should be open to a litigation on that matter if we have taken that view. Because as accountants, when we have to sign the form number 3CEB, we will rely on this kind of a data. We will rely on this kind of an analysis, and you may not have anything beyond this. So at that point, the only way to make sure that we are safeguarding ourselves is to highlight it to the taxpayer that this may be a risk for you in case the authorities question the price. They may not accept the quotation that they've got from the vendor. So in certain cases where we've seen, for example, we've got to an extent where we've asked the vendor also to provide data of similar sales that the vendor has done of similar machinery to other customers. And if the vendor is cooperative, if the vendor provides you that data, that can become an actual transaction. That is not a quotation anymore, because that's an actual sale made by the vendor to another unrelated customer. So if you're able to get the pricing data, then that's helpful. But a mere quotation, that is doubtful whether it can at all stand the test of comparability. Over to you, Hiranmayi.
Right, Ganesh, I agree with you. The next part is should include comparison of the pricing basis. Yes, it should, because in a particular transaction, when we are pricing it, you have a lot of considerations to take. You have a lot of things to take into, a lot of aspects to take into consideration, like the terms of contract, terms of delivery, the product, nature of the product, etc. So and the kind of functions which has gone into, or the value add expenses that has gone into in manufacturing or in providing a particular service. So the pricing basis should also be taken into consideration while we look at a cup. Next, we move on to resale price method. This method is typically used when, in case of distributors predominantly, where a particular good or a service is obtained from a related party and it is sold to an independent enterprise. So we'll have to identify the resale price at which the product is resold, reduce the resale price margin that we are charging to the independent enterprise, adjust for any differences, and the resultant value is the arm's length price. Again, so it compares the gross profit margins that are earned. So gross profit margins are used as a profit level indicator here. Again, it requires a higher level of functional comparability compared to product comparability, and usually used to test transactions involved in purchase of products and when it is being sold to independent enterprises. Yeah, and one important point to note is when the reseller, whoever is selling from, purchasing from the associate enterprise and selling to an independent enterprise, he does not add any substantial value. Here is a small illustration. That is 1 lakh rupees is price which is charged by associate enterprise 2 to the independent enterprise. The resale price is 25,000. So the arm's length price is 75,000. So this resale price margin, this margin of 25% is to be compared with uncontrolled transactions, whether they are also uncontrolled distributors, for example, or if they are also charging a margin in which the margin range in which this 25% falls into, then will be within the arm's length. Then let me just show you an illustration. So for example, there's a manufacturer in US, and he manufactures, he gets the material or a finished product at 75, puts a margin of 25% and sells it at $100 to an unrelated retailer. So if the 25% margin earned by the distributor is within the comparable arm's length range, then we will satisfy the test. Now looking into the practical issues that we might have for the resale price method, it is not always that we might get the gross profit margin data, which will make it difficult to make this comparison. Or sometimes because of lack of reliability of external comparables, internal comparables sometimes might not be available, but that might become the only choice. We talk about function. The third one is we talk about the functional comparability, but sometimes even the product difference might affect the final results of this particular method. And impact of intangibles, trademarks, brand names, etc. to be duly considered. So one point that I mentioned was that the reseller should not be adding any kind of substantial value. So when there is an intangible like a trademark or a brand name in play, or when, for example, the reseller or the distributor is responsible for creating a customer network or a distribution network here, wherever the tested party is located. So in that case, using the resale price method will not be relevant. Let me move on. Next, we have the cost plus method. So this is typically used in a semi-finished goods kind of a scenario. When semi-finished goods are being sold to the AEs, we will identify the costs, direct and indirect costs of production which is incurred, and determine the gross profit markup, adjust for any differences, and we are arrived at the arm's length price. Again, gross profit margin is compared here. And the gross profit which is charged has to take into account the risks that is assumed by the entity and the capital that is used, etc. So the margin that we use to compare here is the gross profit margin. If the in this illustration, for example, they have charged a gross profit margin of about 50%. If this margin is within the comparable range, then we satisfy the arm's length test. What could be the practical issues for cost plus method? So when it focuses on gross profit margins, there'll be different accounting methods between entities. There could be different intensity of functions as compared to a related party entity with an unrelated entity. So that becomes a problem that needs to be evaluated before comparison or before using this method. Again, this requires a high level of comparability between tested party and comparables in terms of functions performed. Functional comparability is required here. And difference in cost base may require adjustment for proper comparability. So different entities or different kind of characterized entities might have different components of cost items. So in many cases, one particular entity might be incurring a particular cost that another entity might not incur. So in those scenarios, we need to look closer before comparison. Then we go to the profit split method. So profit split method is usually applied when you have very closely linked transactions or multiple transactions that are closely linked. Or there is more than one associated enterprise which is making sort of an equal contribution towards the final profitability. In this case, what we'll have to do is determine the net profit, combined net profit of the AEs. So you have A, B, C, D, E enterprises, and then the entire group's combined net profit. Then evaluate the relative contribution of each enterprise. Say, for example, 5 entities are there. Each entity is, say, for example, contributing 20% towards the final profitability. And then we have to split the net profit, basically, based on the ratio. And then that will be your arm's length price. So the profit allocation can be made either through comparable profit split method or a residual profit split method. It's a simple illustration here. The next slide. For example, we have a combined net profit of 100 million. Then we have our routine profits, some specific contribution that we have from each related party, say X limited and Y limited. The contribution made by X is say 40% and by Y is 60%. So the functional, so this 70 million is based on the functions, assets, and risks of each party based on market benchmarks. So 100, the 70 million is split in a 40 and 60 ratio. 28 million will be attributable to X Limited, and 40% will be attributed to Y. Then after the 30 billion, we have a residual profit, which will be split based on, say, for example, factors such as network reach, efficiency of the sales and marketing teams, etc. Another example, for example, this is an example in case of a telecom sector where the Indian entity has an equal contribution to that of the Netherlands entity in terms of network reach, in terms of selling and marketing functions, in terms of their relevant contribution to the profitability of the entire group's business. Because in a telecom sector, there's a lot of back and forth between countries, right? So India has an equal contribution to that of Netherlands. So in such kind of scenarios where there are multitude of transactions which happen each day and they are closely interlinked to each other, and when there is an intangible in play, a profit split method will be most relevant. So what are the practical issues that we might face in a profit split kind of a scenario? Third part, it's very difficult to see third-party entities doing, using this profit split method. So in that sense, it becomes difficult for comparison. Say there are 5 enterprises who are contributing to the profitability. There might be a dispute on what are the value drivers for profitability, or which intangible, or which entity's intangible, or which entity's contribution is more relevant. So that kind of it's very subjective in nature. So comparability becomes difficult. It requires use of data from foreign locations. So 5 different countries and 5 different jurisdictions, we'll have to get all the data. A lot of administrative burden is also involved here. Difficulty in calculating the combined revenue and costs for all A's. So basically, this is a very tedious process on the whole. And how will the tax administration react to this method is again a question. So it has to be done in a very elaborative manner, so which might create some difficulty in applying this method. Next, we have the Tnm method. This is the most frequently used method. Basically, here we compare the net margins. And in a Tnm, typically, a profit level indicator comes into play. The PLI comes into play, which we compare between an uncontrolled transaction and a controlled transaction. To see an illustration here, we have a USD 10,000 operating expenses, and we have a net profit of, say, for example, $500, which is at 5% of the price. So the tested party is making a 5% net profit. We'll have to check the comparable entities who are performing similar functionals. And then we'll have to compare this 5% with whether it falls within the range of comparables that we have selected. In transactional net margin method, usually we have a multitude of comparables, wherein the range concept comes in. I'll be covering that in the following upcoming slides. So this is just a sample example. You have 8 companies, and the profit level indicator used here is operating profits by costs. These are the various margins, and the 35th and the 65th percentile I'll be explaining in the coming slides. 4.94% and 10.82%. So if we fall within this range, for example, we are at a profitability of say a 6%, then we can call ourselves to be within the range, and we are in fact meeting the arm's length standards under the regulation. So what could be the typical issues or challenges in applying a TNMM? We have aggregation or transaction analysis. So aggregation is basically when one enterprise, the tested party basically enters into multiple transactions. Say you have purchases, you have sales, you have reimbursements, you could have a lot of other interrelated transactions. When the transactions are completely interrelated, you can sort of have an option to aggregate the transactions. Again, it will depend on the facts and circumstances of the case. Sometimes it might be accepted by the tax administrator, sometimes it might not be. So that becomes an issue here. Entrepreneur versus captive, need for a risk adjustment. So in a captive service provider or a captive manufacturer kind of a scenario, what happens is in their intercompany agreements, they will agree to pay the captive entity a minimum profitability percentage, say for example, a 5% or a 10%. So in that case, the parent entity is basically assuring the subsidiary entity a minimum profit percentage. So in this case, is there a requirement for a risk adjustment? Sometimes there is a lack of availability of data at the time of undertaking the transaction and documentation. For example, the most current year data might not be available, or for some transaction, for some comparable companies, a company might be a comparable, but availability data will not be available in the public domain. So those could be some of the issues that are there in TNMM. So generally, what method is applied in what situation? For example, for a cup, typically, like Ganesh was also mentioning, in a loan kind of scenario, royalty, service fee, intangibles and guarantee fee, cup may be used. Again, the similarity is very important here. RPM, when we are marketing finished products and when there is no significant value addition to the product. CPM for a semi-finished product. PSM, where some kind of integrated services is performed or unique intangible is involved, we use a PSM. TNMM for manufacture distribution of goods. So basically, if none of the other methods can be used, we can use TNM if that will be more reliable. And other method is, for example, when we purchase second-hand capital goods, we can take a chartered engineer's certificate as a comparison. Or when there is a buyback of shares or when there's a purchase of shares, we can use a valuation report from independent accountants.
I would just add here, Hiranmayi, that in the previous slide, that what is set out here is not necessarily coming out from the legislation. What is set out here is based on our experience of having applied these methods in various situations. Practically, what happens is where the data is available for us to apply the method, we should choose that method.
Choose that method, yeah.
And the other aspect is because an operating profit level factors in all the possible costs or all the possible business aspects, and therefore in a lot of times, in fact practically the data also shows that over 80% of transactions are supported by TNMM. And the reason is because the profitability data is easily available. But the challenge is that what you see as profitability is profitability of an enterprise. We have to get to a transactional profitability. And that is where the difference comes between whether a taxpayer can just simply look at an annual report of a peer group company and say that that company earns, say, 5%, I earn 7%, so I am arm's length. Is that what we try to achieve through a transfer pricing analysis? The answer is no. We have to get to a transactional level profitability. And that, I think, is the more fundamental point of why sometimes TNMM fails, because the profitability data we see of comparables is an enterprise profitability and not a transactional. The second aspect is on the other methods, like for example, the cup method, resale price method, cost plus method. We should never turn a blind eye to those methods, because in many cases we've seen those methods are more appropriate. It all depends on the data available. And on the sixth method, for example, we have seen it being applied where we get data which are compliant with other regulations, not necessarily income tax, but maybe for other purposes. Now, by itself, those data points do not necessarily mean that it's an arm's length price, but because it has been accepted by another regulator to say that it is compliant with the particular regulation, the taxpayer has used that as a basis of arm's length. We as professionals have to evaluate the arm's length nature of that evidence to see whether it can stand test of arm's length in a court of law, because one is the data that is available, but is that data reliable? Is that data actually arm's length price? That is where we as professionals will have to come in and evaluate whether that will, for example, here the examples that are given, a chartered engineer certificate. Now, a certificate may be available for, say, capital good import, and the certificate may have said, what is a fair market value of the imported product. But is that enough for us to say that is an arm's length price, or should we also look at the life of the asset? Should we also look at the depreciated value of the asset, the reason for transfer of the asset to the Indian enterprise? So we as professionals should also go beyond the certificate. I'm not saying that we should question the certificate. For all practical purposes, if the certificate has been accepted by another regulator, it has its own merit, and therefore we should certainly rely on it. But my only point is we should not blindly accept it. We should also look at how the certificate, the assumptions in the certificate hold good. And therefore just keep that open-mindedness when we approach it. We're not, the intention is not to question these certificates, because more often than not, these certificates actually help the customs authorities in forming a view. So therefore they are definitely helpful, but we should have an open mind when we approach it. That was the point. Over to you, Hiranmayi.
Yes, Ganesh. Section 92C also covers the power of the assessing officer in case of assessments, transfer pricing assessments. He can, when can an assessing officer actually go in and determine this arm's length price? When there is enough evidence that we have not, that is the assessee has not determined the ALP based on the most appropriate method, or he has not kept sufficient documentation to prove that he is within arm's length, or to say that we are in fact consistent with the arm's length principle, or any computation or data that we're using is not, if they feel that it's not reliable or correct, or whenever the AO is asking for some information, we are not ready with that information, or we have not furnished it as required by the AO. So in these cases, what the AO can do is he can take whatever data is available with him in his possession, and he can substitute that with the arm's length price, and he can compute his own arm's length price. And but before he does that, he'll have to provide an opportunity of being heard, and show cause notice is mandatory in this case. Moving on. Yeah. Ganesh, can I just wait for a pause, or should I read it out? How can we do this?
Yeah, so we just thought that we can go through these questions, and we would encourage the participants to type in their answers in the chat box. If you have an answer to the question, it's a very simple question. So if you just want to look at it and type your answers in the chat box, we can take them one by one. So in this case, there is P Limited, which is engaged in the business of transmitting data from a destination in one country to a destination in a different country. This transaction requires assets and functions to be deployed of different associated enterprises, then located in different locations. So there are various enterprises involved in the entire supply chain. What should be the most appropriate method? So here the question is, first of all, what is the transaction? And Hiranmayi, you may want to explain what is the transaction that is being subject to transfer pricing here.
So there's data transfer, and for that data to be transmitted, it has to go through a lot of associated enterprises which are involved in line up to the final location where the final delivery of service. So it's just not one entity, but a lot of entities are involved, and each entity is equally responsible for assets. They deploy their own assets and functions. Each associate enterprise is equally involved in delivery of the services. So in this case, yeah, I'm seeing an answer. Yeah, I just saw an answer, Ganesh. That is right. Profit split method is the correct answer. Should we move on, Ganesh?
Yes, please.
Mr. Ganesh, there is a question in chat box. Can you see that?
Yes, yes, I can.
From
Yes,
Babu
yes,
Shankar. You answer or you later you can answer? What?
I thought I'll just cover these questions on the quiz that is presented. I will certainly come to Mr. Babu Shankar's question for sure.
Okay, fine. No issues. No issues.
Hiranmayi, do you want to read the question so that?
Yeah, sure. So during the year, A Limited availed subcontracting services from its associated enterprise in relation to a contract awarded by X Limited, an unrelated third party, to A Limited. The entire work under the main contract of X Limited has been subcontracted by A Limited to subcontractors on the back-to-back basis. The most appropriate method that could be adopted would be
Any answers from anyone? What could be a method for this transaction of subcontracting? So the international transaction under question is the subcontract by A Limited to its associated enterprise, isn't it?
Yeah. Are you able to view the answers, Ganesh?
We have an answer that it is Tnm Method in mind.
No, the answer here would be cup, because the contract is subcontracted on a back-to-back basis. So a contract from a third party, and then it is subcontracted to the associated enterprise on a back-to-back basis. So there is no other, since I've used the term back-to-back basis, there's no value addition happening here. So since it's a direct subcontract kind of a scenario, it would be cup method in this case.
So the important aspect here is to be able to demonstrate that the, say, A Limited has not added anything to the work done by the associated enterprise. And
Right.
A Limited essentially delivers the work of the associated enterprise to the customer. So if you are able to demonstrate that, then the customer, the price that the customer is paying to A Limited for the service is representative of the price that the associated enterprise should earn for the service. So that is the principle. Now, particularly, we've seen this arrangement working very well in the technology sector, where there is always this subcontracting that happens. There is an entity which, say, for example, in an overseas location, where the customer has approached that entity in the overseas location to do certain work, and that entity subcontracts that work to, say, an Indian enterprise, its a group company, to perform that work. Now, if we see that in that case the overseas entity has not done anything to that project, but it's the Indian entity which is delivering the work, can we use the cup method? So these are aspects that could be considered in this arrangement. Go ahead, Hiranmayi. Yeah. Can you just spell it out? Yeah.
Yeah, A Limited is engaged in purchase and distribution of cosmetic products in the Indian market from its AEs. A Limited was responsible for marketing the products and creation of a distribution network in India. In the given scenario, A Limited distributes the products purchased from its AE without further processing the products. The most appropriate method in this scenario would be yeah, I'm seeing a response. Yeah, correct. Mukesh, RPM is the right answer here. Yeah. Can we move on, Ganesh?
Yes, please. So
Yeah.
before you move on, I think I'll just address the question from Mr. Babu Shankar, who's set out a question. We are in manufacturing, around 5% of raw materials was imported from holding company in Italy, and our sales to holding company is less than 0.1% on our sales. We pay royalty on our sales. We adopted TNM. AO's proposed adjustment of 3% on overall turnover. Is this correct? If it's only related party foreign transactions, then it should be only on imports from related party by sales or sales to related party and on royalty payment to related party. So, Mr. Babu Shankar, what you've spelled out is the fact that the transactions with our related parties is fairly limited, and therefore proposing an adjustment based on overall turnover doesn't hold good. And I agree that is absolutely the point that I was emphasizing, that we need to look at transactional profitability and not an entity level profitability. At the same time, I would also say from practical experience, the AO would do only what the taxpayer can submit. So if we, for example, are going in position in our transfer pricing documentation is we've used, for example, an entity-wide profitability because that's the data that is available for comparables, then the AO will take that as a basis to do an adjustment. Having said that, I think there are a lot of judicial rulings on the subject that even if an adjustment is made, it cannot be made at an entity level. It should be made at a transactional level. So what I would suggest here is to look at each transaction. So the raw material import, the royalty payout, and try to benchmark them separately rather than aggregating all of these. Because if we have done that, then it is easier then for the AO to use that as a basis to do a different way of adjustment. That is one. Or even if the AO continues in the same basis to do an adjustment on the basis of overall turnover, then you would be able to have a solid case before the higher appellate authorities to say a transactional approach is more warranted. And there are enough judicial precedent on that. So therefore, from that standpoint, I think it is important to document each transaction as a method. For example, we've seen in a lot of cases in manufacturing concerns where the method that is selected is TNM. Because at the time of certification, the taxpayer says, overall, I've earned a good profit, so it should be TNM. So the taxpayer signs off, and the accountant also signs off on that method. But at the time of assessment, of course, the AO does his own comparability analysis, comes up with a set of comparables, and then the debate starts as to whether it should be 3% or 10%, etc., and whether the adjustment should be made at an enterprise level or a profitable transactional level. So that's another risk of a TNM method, because that can, the profitability can vary. So my short answer to your question is, have a transactional approach to documenting the arm's length nature of each transactions, because as a whole, if your intercompany transaction or international transactions are not material, then you wouldn't use an entity-wide approach to benchmark them. So that's something that you could consider. But on your point on how do you go before the AO, I think you're well within your right to go and explain why the 3% on overall turnover is not correct, and there are enough and more judicial rulings on that subject. I hope I've been able to answer your question, Mr. Babu Shankar. And the next question is from my fellow professional, there's a question on 100% software export services by wholly owned subsidiary to foreign holding company. What method is suitable? Typically, again, it's if the international transaction is export of software services to the holding company, and assuming that the holding company has people who oversee the activity of the Indian company in terms of what work has to be done by the Indian company. And I say that because then the Indian company is then seen to be doing more like a contract services. It is contracted by the holding company to perform services. So therefore, then the easier way to test the result of the Indian company in terms of arm's length price is a TNMM on an operating level basis. Now, if this is the only transaction, as you said, 100% software export services, then TNMM will be more appropriate here. If on the other hand, as I explained in another situation where the holding company does not do anything other than just getting the customer contract and passing on to the Indian company, and then there is a measure of the price that the customer pays to the holding company, if you could access that data, perhaps you could look at also a different pricing mechanism like a cup as well. If that data is something you can look at. So that is my answer. We can move on. I think there are no further questions at this stage. But thank you, for my fellow participants for raising these questions, because these are very good questions. Please keep them coming. Thank you.
Thanks, Ganesh. I think there's one more question, Ganesh.
In continuation above, adjustment should only on revenue side or expense side also. Yeah, so it is the transaction, the international transaction that would be the subject of an adjustment. So you would have to work back to see, for example, if it's the transaction is import of raw materials, then you will have to do a proportionate adjustment. So import, what is the import as a percentage of total purchases of the Indian enterprise? And therefore, if we apply that same proportion to these revenue side also, to say that that is the measure of the income that could be earned attributable to the import, that is how we'll have to work out the adjustment. So it is not necessary that whether the adjustment should be revenue side or expense side. I think it has to be proportionate. That proportion has to be computed, and then the adjustment, the TP adjustment could be worked out in a revised manner. Thank you, sir.
Yeah. So now moving on to section 10, rule 10C actually, rule 10CA. So what this rule says is when there is when there is more than one price which is determined by the most appropriate method, and how is it to be computed. So if a single price is arrived, yes, that is the ALP. If not, then a range concept will become applicable, or a mean when there is less than 6 entries. So yeah, multiplier data construction is only allowed for determination of ALP under a TNMM or an RPM or a CPM. And range concept, when does it become applicable? When there is a cup method or an RPM method, CPM or TNMM method, and data set constructed is more than 6 entries. How to apply this concept? We'll first have to arrange the values in the ascending order, the least to the highest number. Then the actual transaction, when it is falling within the 35th percentile or 65th percentile of the data set, then we can say that a particular transaction is within arm's length. And when it does not fall within that range, then the median that we find out will be taken to be the arm's length price. I have a small illustration which will cover this. So in this case, we have 7 comparable companies. We'll have to compute the weighted average by aggregating the profit level indicator used here is operating profit by operating cost. We'll have to aggregate. So I'll just take one scenario. For example, for A company, the operating cost is 100, 150, and 225 in the 3 years, year 3 being the current year. When we aggregate it, we have a 12% of weighted average. So when we compute the weighted average we compute the weighted average of all the 7 entities. Then we'll have to put it into ascending order, lowest to the highest. And 35th percentile is nothing but the number in the data set. We had total of 7 comparable companies. When we take 35% of 7, it is 2.45. We should always round off to the next number. So the third value, which is 8.2. 65th percentile will be 7, the number in the data set, into 65%, which will be 4.55. We take the fifth value, 10.57. And median is nothing but we take a 50%, 3.5. So we get the fourth value, which is 9. So the range will be between 8.2 to 10.57 and the median will be 9%. In case we have an even number as a data set, for example, we have 20 comparables, then the 35th percentile will be 35% of 20, which will be 7. In that case, we'll have to take the mean value between the 7th and the 8th one. And in case the 65th percentile, it's 13. So the mean between the 13th and the 14th. And when it is 10, the mean value between 10th and 11th. So we'll have to take the 10th value, the 11th value, and take a arithmetic mean of those values. That will be our median. Yeah, with that, there is one more question. Simple one. Z Limited is engaged in the business of export of coffee beans to A Inc., the parent company. Z Limited is characterized as a tested party based on the FAR analysis. 4 comparable companies were identified based on search process. In order to determine the arm's length price, we would be using which of the following? Any answers? Simple one.
We have an answer as mean, Hiranmayi.
Yeah, that is correct. Thanks. That is correct. So we are at the end of the first topic. Should we, Ganesh, should we go for a 2-3 minute break, or should we just continue? I think are we a little short of time?
Yeah, so we can continue, I think,
Okay.
because we have a fair ground to cover.
Yeah.
Maybe after this next session, we'll take a short 5-7 minute break. But
Sure.
now I think we should cover so that the flow
Sure.
is continued.
Sure. Yeah, that is the end of the first topic. Maybe over to you, Faiza, for covering filters and PLI.
Sure.
And then
So
yeah.
So thanks, Hiranmayi, for your time. And as I hand over to Faiza, I would just make a mention that I compliment both of you for preparing for this session. And typically, when we talk about methods and the applicability, the one aspect which is very important is how do we actually practically determine the price? And we went through some examples in the previous 1.5 hours on how the method is applied, in which cases the methods are applied. Now, having crossed that bridge, having selected a method, for example, say a Tnm method, because when you have a cup method, it is fairly easy because you first identify those transactions. So for example, an import of machinery, you see the cost sheet or you see an invoice of a similar machinery having got purchased from a third party, and you do a comparison of the price. So that's the easiest way to compare, just to keep the thing very simple. Similarly, import of products, and we've seen, for example, import of steel, import of iron ore. There will be a lot of data from metal exchanges where the pricing information for those commodities are available. One could look at the pricing and assess, from one origin to a destination country, what is the going rate, for example, for similar purchases. So when we talk about cup method, it is data intensive. You can collate data and you can present it in a way that is, and you can see what is, how does the arm's length price come into the picture. When we go into a profit-based method, for example, say the TNMM, I will leave out PSM for now, profit split method, because there is a way we have to delve into it. We'll have to look at comparable arrangements, because those arrangements have to be strictly comparable in a same manner. But if for once we park that out, but we look at the other methods like the resale price method or a cost plus method or TNM, we have to go about identifying transaction or enterprises who perform those activities. And often enough, from experience in the past 20 years, we've seen that tax authorities are fairly comfortable, for example, with use of various databases, because databases give a very objective information on what other companies in the peer group are doing. I can share my experience here that when I was working in Malaysia many years back, and I was closely interacting with the Inland Revenue Board of Malaysia with respect to how do they do the benchmarking, how do they do the comparability analysis. It was in a way interesting to see that the approach was very time intensive, and typically the way it would happen then was you would identify a set of companies from yellow pages, something similar to yellow pages or a trade directory. You'll pick up the names and then you will go to the company's house and you will ask for the annual report of those companies, and you'll have to sit in the company's house and skim the information to capture the data and then come back and feed the data into, say, a report. And that's how you explain the transfer pricing analysis, which is extremely time intensive for a taxpayer who has so many transactions. So but today, thankfully, we have various databases that give us the information, and the institute has also gone a long way to help members like us, for example, to get these databases accessed at subsidized rates. So that also helps us as a practicing CA, for example, to benefit out of these collaborations. So with these databases, I think then the advantage is we have more data to look at, and at the same time we can also reach out to the taxpayers to say the requirement for use of this database, because even the tax authorities use these databases. So in the next few slides, we'll also go through practical ways of doing this search process using these databases, which will help us then come to a conclusion of how do we arrive at the final set of, say, comparable transactions and determine the arm's length price. Over to you, Faiza.
Thank you, Ganesh. So moving on to how to select the filters or selection of PLI and the relevant case studies. Today we would look into typically the most used profit level indicators, the data sources and the time period, how do we select the time period, and the selection of filters and case studies in this regard. Next slide here. Okay, selection of a profit level indicator. Once we have determined the selected the tested party based on the characterization and the FAR analysis performed, we see that PLI is nothing but the profit level indicator. It should be consistent with the FAR analysis and the characterization and the pricing policy of the tested party. PLI is nothing but a ratio that measures the relationship between the profits and costs incurred by the tested party. We would be able to measure the ratio of the tested party with the comparable independent comparable companies. Okay, we note that PLI should always have an untainted base. First, in order to understand what is untainted, we should see what is tainted. In the parlance, that tainted means any income or expense that has been incurred with a related party, like an associated enterprise, incurred in relation to that transaction. Whether an income has been paid to an associated enterprise or the income that has been received from an associated enterprise. That particular transaction is said to be tainted, because here, in order to determine the arm's length price, we are looking into data of independent parties and seeing their comparability to benchmark the arm's length price. The data that we are comparing should be independent and more reliable. So in order to see the reliability, we should adopt a base that is untainted. For example, in case of an export transaction, the sales made to an associated enterprise would be tainted. So we shouldn't consider that as a base. Instead, we could consider the cost as a base for export transactions. And similarly, in case of import transactions, the cost would be tainted because the cost has been incurred in relation to you have paid that cost to the associated enterprise. So here, considering revenue as a base would mean that untainted. By considering an untainted base, you see that the data that you're comparing is independent and more reliable. Now, the selection of a PLI basically depends on various factors. We should see the nature of the transaction that is being undertaken, like for which you are comparing the transaction under review, the nature of activities performed by the tested party, and the reliability of the data available. So these are the few factors that you should look into to select the appropriate PLI, that is the profit level indicator. Slide here. An overview of few of the profit level indicators under various methods are basically PLI is applied in the cases of RPM, that is resale price method, CPM method, cost plus method, and TNM, transactional net margin method. In CPM and RPM method, we look at the gross level margins, and under TNM method, we look at the net level margins. For example, there are various PLIs available which could be used in cases of the appropriate, in case of the each tested party. It depends on the tested party's activities and FAR that has been carried out. So for example, gross margin, that gross profit by sales, could be used in the case of a distributor. And cost plus method can be used by a manufacturer. Whereas transactional net margin method gives return on total cost. This could be used in case of a contract contract manufacturer or a toll manufacturer. And here there's one more point to note, that operating profit by total operating expenses. So what you consider as operating expenses depends on the characterization of the tested party. What the tested party categorizes the operating and non-operating expenses, that also should be looked into. So these are the various level of various PLIs that could be used, like operating margin in case of manufacturer or distributor. Return on assets is used in case of a manufacturer who is into asset intensive business, like where the assets are more employed. And operating profit by value added expenses is used in cases, for example, in the case of a logistics service provider who would basically provide a value added expenditure to the cost incurred. So these are the various types of PLIs that are being captured here, and the typically used in cases where each of the tested party is involved. Like you could see the Berry ratio, gross profit by operating expenses, used in case where it is a low risk distributor.
So just one point to add here, Faaizah, to what you presented, and thank you for putting out all these possibilities. One aspect is, again, I'll come back to the tainted transaction, etc. So if we look at a resale price method, which is applied in the case of distributor, the transaction that is typically tested here is the, say, import of finished goods or purchase of finished goods from a group entity. So assuming the distributor is in India, the distributor imports finished goods from its group company outside India and it sells in the Indian market. So typically a resale price method would be applied in that case to test whether the import of finished goods is arm's length. And therefore, if you see, the PLI that is used is gross margin, gross profit by sales. The sales made by the distributor is to third parties, is to the market in India, for example, or to retailers, as the case may be, who are independent. And so the measure that is done here for this arrangement is how much is the gross margin that the distributor has earned from an independent sales, and that is compared against third-party comparables using the same PLI, gross profit by sales. Similarly, if you look at the manufacturer, for example, a manufacturer may import raw materials from its group company manufacture and sell products, or it may be supplying products. So it depends on which side of the transaction, which side of the P&L is the control transaction. If the control transaction is on the selling side, for example, the manufacturer is manufacturing in India and manufacturing the finished product and selling it to a group company outside India, then the sales is a control transaction. Then you look at the costs side of it, and then you look at a return on cost. On the other hand, if the import of raw materials is the control transaction, the manufacturing is done and then sold to third parties, then you would have to look at, say, a Tnm to see that what is the overall return the manufacturer has earned from sale of the products. Then you would perhaps look at an operating profit by sales. So the thumb rule is you use a base in the PLI, which is the uncontrolled element. That's the point that I wanted to leave. Faaizah, if you can continue, please.
Yes, Ganesh. Thank you, Ganesh, for adding the point. Now moving on to the sources of data and the selection of time period. Sources of data, basically there can be two types of data that can be is available. There are internal comparables and external comparables. Internal comparables, as we have already seen, as discussed by Hiranmayi, is that where the associated enterprise has a transaction, where an entity has a transaction with its associated enterprise and a similar transaction with a third party, then in such a case, if the transaction is similar, then that could be used as an internal comparable, and the price charged by the third party can be used as an internal comparable to see the data, whether the arm's length price of an associated enterprise is in line with the third party price charged to the third party. The sources of data available in external sources are through the government, like you find the statutory public filings in the MCA, you find the annual reports, or any other websites where you could find the company website where you would be find the annual reports of the comparable companies. Then there are commercial databases like the TP Capital Line, TP Database, ComputeStat, the Royal Stat, where the data of the comparable companies is provided to you based on the PLI selected. Also, in the data sources can vary based on whether it is for the domestic companies that you're searching for or the foreign companies. So that as well depends on the source for what you're looking for, the comparable companies that you're looking for in specific regions. You can even understand the internal comparables by inquiries with the management, because that's how you would know whether there is a third party transaction that has been carried out, and you could compare that with the transaction of the associated enterprise. Now, selection of the time period. It is stated in Rule 10B that the multiple year data could be used in cases of the RPM, CPM, and Tnm methods. So in these cases where multiple year data is used as a comparable of the comparable companies, you see the for it to be comparable, the current year data or the year preceding the current financial year data should be available. Then only we could say that the comparable data is available, and then the database would be used to compare the data of the tested party. The comparables data could be used to would be more reliable to compare it with the tested party. Next slide here.
So the key point here is in order for us to be compliant with the law, because the law is very clear, you have to use the data for the current financial year and and you can use the data for 2 previous financial years. And this legislation has also made it easier for taxpayers to rely on historical data. So therefore, one is to see companies, similar companies being available as comparables. Second is the data for those companies should be available for that period. So therefore, this is the combined test that we have to fulfill, and we'll see that through an example. But the point is that we should not restrict ourselves only to selecting a peer group comparables. We should also see whether the reliable data is available. That I think is more critical. In a lot of cases, we've seen, for example, where we've used overseas comparables, so foreign comparables. The challenge that comes up is the data presentation, in terms of the accounting standards they follow or the way they compile the results, may not give you the most optimum way of measuring arm's length, because there may not be, for example, they may not disclose gross profit. There are certain companies which don't need to present a gross profit information. They have to just present an operating income. Then how do you at all compute a gross profit? Then you'll have to look at their detailed P&L and see which elements you are considering for your tested party. What are the elements you're taking for the purpose of computing gross profit? You'll have to do it for the comparables. So the data presentation is also a very critical factor in selecting the comparables. Go on, Faaizah.
Yes, now looking into the basic filters while performing a search. So in order to benchmark a transaction, we would have a number of comparable companies in the database. Now, in order to filter those companies and arrive at the final set of comparable companies, we have certain criteria that could be used so that we identify the comparable companies to the tested party. The different criteria, for example, like on the basis of a size or the scale, like a company having a turnover of 10 crores is not comparable with a company having a turnover of 100 crores. So in such a case, we would apply the size or scale filter based on the sales or assets or the number of employees, which is relevant to the tested party. And the next criteria would be intangible related criteria. For example, the tested party is not involved in, it does not own any intangibles. For example, in case of a licensed service provider, whereas there would be comparables who own intangibles in case of entrepreneur service providers. So we would apply this criteria to select the comparables that are comparable to the tested party. Country of sales. Now here, you would be selling to different geographical regions, be it APAC or Europe, or just India. So based on the country of sales, your criteria would differ, like the profitability margins, the PLIs used, all those costs as well would differ. So that is why this criteria of country of sales could be used to filter out those countries. And the stock holding, coming to the stock holding and inventory in absolute relative value, basically where an entity has holds more inventory, whereas a service provider wouldn't hold an inventory. So in that case, the criteria of stock holding could be taken into account to filter out those companies. The other criteria could be, for example, a startup companies and bankrupted companies wouldn't give you a comparable information. Like those wouldn't be reliable. It wouldn't be reliable to rely on those comparables because they would be in the initial stages of making profits or losses. So in that case, we could apply the other criteria to filter out those companies.
I'll just make a point here, Faaizah, and given that we are in Bangalore, we've seen a lot of situations where tax authorities select companies, and it's a common thing to say, for example, in a tech sector, if my company is doing, say, export of tech services, then I often see myself being compared against, say, premier tech companies like Infosys, Wipro, etc. because the comparison is on the basis that functions are broadly similar. But what is ignored is the intangible, for example, here. And the reason why doing these filters, applying these filters become very important is, as a taxpayer, you set the context of comparability. If we don't set that context of comparability, we will be prone to any adjustments that the officer would do. If I myself don't say that an intangible is a key differentiator between me and comparables, that I do not possess significant intangibles from my side, and that if I don't mention that upfront, it is but natural that an assessing officer or a transfer pricing officer would say that because you compare yourself against anyone, I would also compare you against Infosys. So in our analysis of search process, we need to bring out very clearly what affects my business, what is it that I have which is distinctive or I don't have as distinctive. The other aspect is, and this is another observation I've seen, for example, in various assessments that I've had with the transfer pricing officers in Bangalore, is often enough the scale criteria is used. For example, the scale of business. So for example, if my taxpayer has a turnover of say a 20 crores, right? And therefore I want to select companies which are also in the same turnover, say 1 to 50 crores or 1 to 20 crores, etc. Now, I may be able to achieve that comparison by scale because I'm comparing similar top line companies. But what I don't get is there are those companies, the results of those companies which are in that 1 to 50 crore turnover might be extremely volatile. So there are certain companies in that turnover bracket which will suddenly have a spike, and that spike can double their profit margins. Whereas you as a taxpayer would likely be stable because you operate as a fixed business. And therefore, just by selecting companies based on scale may not be enough. One has to see whether that scale has an impact on profits. Because if the scale has a very different correlation to profitability, because of say one-time contract or one-time event that has happened for the comparables, then that may distort your the arm's length price that you determine. So be careful of applying these filters. That is my message that I wanted to draw. Just don't apply these filters because these are presented in this slide deck. Please look at it in the context of the business per se, because I've practically gone through it with various officers trying to explain why a certain filter is not appropriate. And what we've often heard from the officer is, in the taxpayer study, for example, the taxpayer has not indicated that scale is not a basis for comparison. So we've applied that therefore. So it is important for us as professionals to make it clear in the search process what filters are applied and why, so that then at a time of an assessment, we are fairly comfortable in explaining that position to the officer.
Sure, Ganesh. Thanks for your inputs. Just an illustrative list of what are the basic quantitative filters and specific quantitative filters. Like, as we have seen that sales should be more than 0, like, so that we don't have, and it should be 1 out of 3 years. Basically, we don't take into account the startup companies or any high level fluctuating companies. So we see that this is basically the turnover filter. Then the sales, manufacturing or sales trading, like it depends on the activity that the tested party is carrying out, whether it is into manufacturing or trading. So that also can be applied as a filter. Then industry in which the comparable companies, the tested party is operating, it can be various industries like IT industry or automobile industry or textile industry. So we apply an industry related filter. Ownership filter is basically applied to select the companies that are independent, not into governmental, not non-governmental companies or non-cooperative companies. So we apply the ownership filter to select the independent companies. Net worth companies, we apply the net worth filter so that we don't select companies that are having a negative net worth or where their net worth is eroded. So net worth filter helps us to see that the tested parties comparables are independent and their net worth is not eroded. Then the sales turnover, sales filter of more than 1 crore. This can depend on the tested party. It need not just be 1 crore. Like Ganesh has already indicated that where the tested party has a turnover of more than 50 crores, then applying more than 1 crore wouldn't be appropriate. You should apply the turnover filter based on what your tested party's details are, the FAR analysis. And net fixed assets or intangible filter. This filter would be applied mostly in cases where to reject companies for, we are selecting companies for a service provider. Then in that case, a service provider wouldn't have more in fixed assets, like it wouldn't employ more fixed assets or intangibles, more fixed assets. In that case, we would use this filter to reject companies who have high fixed assets employed in their business or capital intensive companies. Then the specific quantitative filters would be relating to export companies, R&D, employee cost, inventory, and value-added expenditure or total sales. All these filters are actually just an illustrative list where you should be applying these filters based on the functions and assets and the risk assumed by the tested party. It should be comparable to your tested party and thereby apply the filters. Not just each filter that is available should be applied irrespective of since it has been mentioned. Thing to add, Ganesh?
Yeah, I would only say in the previous slide that, and this is a question that has come from one of the attendees, that the officer runs a search process and did not find the companies which are closest to our business as comparables, and therefore has gone ahead and selected a set of comparables. It is quite common. I appreciate the question that has been posed here. So typically what we've seen, what I've personally also seen, is the database that we use or the officer uses classifies companies in different ways, depending on various parameters. So it may be based on the significant income earned by the company, whether it is classified as, say, a manufacturing or a trading. So the database provider does that classification. You and I don't have any control on that. Okay, so that is what is that is how the database is done. That is how the companies are classified. Now, when we run a certain search process, we select a certain industry, sub-industry, etc., or we may apply a keyword and select comparables. And it is quite possible the companies we think are our comparables don't come in the set because of some reason. It is always a good idea not just to work in a tunnel vision to say that this is how what is from the database, so this is what is our comparable. We should investigate beyond it to say whether the company that we are looking for is classified in a different sub-industry or in a different industry. And I've seen, for example, a company which is, say, manufacturing engines being put under a category of railways. Although the engines is done for various other automotive applications, but for some reason the database provider has classified it as railways, transportation, etc., and it is not under manufacturing for, say, automotive as a sector, because of which you get the company but you don't get it in your research results because it is classified in a different category. As a taxpayer, you wouldn't also select railway transportation because that's a very different industry, because that's not something that the manufacturing of engines will fall under, that but the database has classified it differently. So I think as a professional, what we need to do then is to investigate why some companies are not appearing in the database. Sometimes these companies are not at all present in the database because the data is not available about them, because either the data is not reliable, available, or not published for whatever reason. But in many cases I've seen the data is actually available but is classified differently. So as professionals, I would suggest, and what I have done in these cases is gone ahead, checked in the database by entering the name of the company and seeing under which classification it has been put under, and see whether I can broaden my search to get that company in, because that company is a comparable. And under the OECD, for example, the OECD guidance on comparability and the application of transactional profit methods, including Tnm, the OECD has also recommended that you could use an additive approach. So you could have a set of search process, you apply a search process, you come up with a set of companies, plus you've identified additional companies from the industry that you see are comparable, but for some reason are not appearing in the search process. it is always a good idea to add them and present it. Yes, at a time of an assessment, the officer will ask you, did you cherry pick these companies just because they had good margins, you selected them? But that is where we have to bring our point of view on industry comparability, that these companies actually are comparable to me because they manufacture similar products or they perform similar services, etc. So let's keep that open-minded approach to comparability, because databases have their own limitations. So I hope I've addressed my the question from the audience, and I think we can move on. Faaizah.
Sure, Ganesh. Once we have filtered out based on the quantitative filters, there is a qualitative analysis that could be carried out based on the functional or the product profile. We have, as Ganesh has already told, the functional comparability is more important than the product comparability. So we need to look at the comparable companies after the quantitative filters have applied, whether they are functionally comparable to the tested party. How this could be done is by reviewing the annual business description available in the annual reports or the company's website. And you could consolidate the qualitative analysis, and you could even check for whether the comparable companies are making consistent loss during the 3 years. The 3 years that you have identified to be, you would use the multiple year data for 3 years. So whether the company is making loss in those 3 years. So that filter could be checked in qualitative analysis. Then the sensitivity analysis. Sensitivity analysis looks into whether there is any merger or acquisition due to which the profits of the companies have increased substantially, or any, for example, any supplier of yours of the company has actually been bankrupt. So in that cases, you would actually see that those companies are not comparable to your analysis. So we would filter out those companies in the sensitivity analysis. And the most important criteria under the qualitative analysis is the Rpt filter, that is the related party filter. The very objective of carrying out the benchmarking process is to identify comparable companies that are independent and which have the more reliable data. When the comparable company itself has a related party transaction, then those companies would have the data of those companies wouldn't be reliable. That is, they would also be carrying out uncontrolled controlled transactions. So in order to filter those companies out, we apply a related party filter based on specific thresholds. For example, those companies having more than 25% of RPT could be rejected in this qualitative analysis. Now moving on to the case studies, I would like Hiranmayi to take you through the case studies.
Thanks, Faaizah. I just wanted to add one point from the previous slide from my practical experience. Just a second. So these consistent loss makers, what happens is in one or two of my cases, what happened was the comparable companies that the taxpayer had selected were making consistent losses. So when we actually personally asked the tax officers on what they consider as consistent loss makers, so out of the 3-year data, if a particular entity is making losses for 2 out of the 3 years, then they treat it as persistent loss makers. And irrespective of the facts of the tested party, even though the tested party is in fact a loss maker, they are still not considering persistent loss makers as comparable entities. So just thought I should mention that here. Moving on to the case laws. Yeah. So this is a scenario where there is a company A, parent entity in US, and the US entity is involved in giving a procurement schedule, giving the manufacturing requirements, the specifications on how to manufacture, whereas the Indian entity undertakes the procurement of raw materials and manufacture based on all the instructions which is given by the company A in the US. And India undertakes warehousing functions and the final quality control and export related activities. Typically, you can see here here it's a contract manufacturer kind of a scenario. In this case, what are the some of the qualitative and quantitative filters that can be used are these are just illustrative. It will depend on case to case. So we can use the turnover filter. I mean, it need not be 1 crore as Faiza and Ganesh were mentioning. It's based on the scale of the this thing. But generally, what is used, what is prevalent is a turnover quantitative criteria. Then we have the net worth criteria. Usually, a positive net worth entity is used. For the prior year, L or L minus 1 is nothing but the current year or the immediately preceding year when the net worth is positive. Then, of course, we take ownership filters to exclude government companies, if any. Functional filters, in this case, we saw it was a manufacturer, so we make sure that we leave out the service providers. And industry filters, we'll have to necessarily choose the comparables from the industry in which they operate. So these are the basic filters. Then we have the qualitative criteria. So we'll have to ensure in qualitative criteria, we'll have to ensure that anywhere in the financials, if they have specifically mentioned that it is a contract manufacturing kind of an activity, if we can see whether they own inventory or not, or if we can see that they have a substantial amount of job work charges that is being charged. So those are some of the qualitative criteria that we can observe from the annual reports or whatever information is available from the public domain, and we can use those filters. Then we have, of course, the Rpt filter, which is the most important filter. We should be having a minimum of 25%. This is just a suggestive percentage. But I have noticed that the assessing officers, the transfer pricing officers are also using a 25% as the Rpt filter. Rpt criteria, greater than 25%. Companies having greater than 25% are being excluded. So in that scenario, this is just an example of a search summary that happens. Tested party year, assuming it is 2020, we take the 3 years prior, 2020, 2019, and 2018. Capital line is the database. If you see the quantitative screening, we have the turnover and the net worth filter. Ownership, only privately owned entities. Function, manufacturer. Industry, keeping only the companies and segments with industry similar to that of tested party. So in that, if you see the entities are getting reduced. The entire database data set has about 59,000 entities, whereas we apply all of these relevant filters based on the facts of our case, and then we have the qualitative review. A separate analysis is undertaken to ensure that the functionals of the tested party and the functionals of the comparables are relatively similar. And of course, the Rpt filter, and we arrive at the 10 comparables, after which we do the 35th and 65th percentile and the median computation, like I had mentioned earlier, to get the range.
So I would only highlight here that the reason why this kind of a table is presented is to give comfort to the tax authority that there is an objective process that is followed. And it is not like we've decided to include, say, 5 companies and we just ended up with the 5 companies. So the objective of presenting it in this manner, and this is just one example, there is no prescribed format. If you look at, for example, the way the OECD has recommended a search process to be presented, there are some good illustrations in the OECD text on this as to how a search process and the result can be presented. We've taken those best practices to present it here in the screen. As much as it is presented as an objective basis of why a criteria has been applied, I think in this table, one aspect which is missing is the rationale for a certain filter. So if you've applied, say, turnover greater than 1 crore, what is the reason for it? Is the reason to eliminate smaller companies? And if we've applied a turnover greater than 1 crore, have we also applied an upper turnover filter? And if we have applied it, why have we applied it? So it may be a good idea to also add another column to say the rationale for applying a certain filter. And the other test of comparability is also that which filter helps you minimize, or maximize the exclusions. so that you can play with only a few set of companies to evaluate them. Otherwise, going through all of these companies can take a long time. And therefore, how do you kind of limit the number of companies? So that the effectiveness of a filter is also something we should bear in mind. So that's from my side. You can proceed, Hiranmayi.
Thanks, Ganesh. In this case, again, there's an entity in the US which asks for support functions from an entity in India. And in the Indian entity provides IT services to the US entity. Functions of company A, they design the strategy, they design the IT systems, supply chain management, sales, and quality assurance is the responsibility of the US entity. Whereas the entity in India is purely a support entity to the US group. They are involved in the basic admin tasks here in India, like staff recruitment, quality control, and general administration. So typically a captive service provider kind of a scenario here. Just presenting this qualitative and quantitative filters. Again, you'll have the basic filters like the turnover and the net worth, R&D filters, net fixed asset filters. Here, since they will not be having R&D expenditure here at all here in India. So if it is having the companies which are having high R&D costs are to be excluded. And any companies which are into the net fixed assets by sales ratio is to exclude companies which are into manufacturing and which are holding substantial assets which will not be relevant for provision for a service provider. When we look at the qualitative criteria, we have to keep the companies which are, here we have to look into the annual reports and see how the entities are, whether the functions performed by the entities are closely linked to each other. Certain words sometimes may be used for such process. For example, for an IT service provider, you'll have different you have software development, you have IoT services, you have big data analysis, you have infrastructure management. There are so many different varieties of services within the IT sector itself. So if you want to pick out a specific kind of service, for example, the entity is involved only into infrastructure management services, or there could be an entity who is a pure BPO kind of a service, business process outsourcing kind of a service, or just purely support services, then those kind of companies needs to be selected separately. Yeah, and sometimes when we look at the annual report, or when we even look at the intercompany agreements, if at all that is available, it will be clearly mentioned that it's a captive provider entity and a fixed margin is charged. So in that case, we can exclude those companies which are not. Again, for the scenario I just talked about, these are the various filters that will be applied: the net worth filter, turnover filter, R&D filter, and net fixed asset filter. And here in the functions, we have selected service provider. And then we are ending up with 8 comparables in the end. Going on. Yeah. So this is a case study on cup. I'll just quickly go through the illustration and then I will explain. So company A, which is based on USA, is the owner of a PQR brand of cosmetics. Company A has entered into a marketing and a distribution agreement with for the PQR brand of cosmetics with company B, based in India, for the Asia Pacific region for a period of 15 years. Company A has also granted an exclusive license to use the brand name of PQR and related service marks to company B. PQR brand is a well-established brand across the world and has continued to earn profits for the group. For the use of PQR brand, company B is required to pay a royalty of 2% of the gross revenues to company A. For the purpose of benchmarking, CUP method was selected and search was conducted, which provided the following comparables. So we have different parameters. We have on exclusivity, we have on region, period, brand visibility, and pricing model. So which of these do you think would be the most relevant comparable? So company A has an exclusive license to the brand. So we will have to look at exclusivity. Then we have region, the Asia Pacific region. So we'll have to choose an agreement in that particular region, which will be more relevant. Well-established brand. So we need to look at a brand visibility which is high or a medium, and pricing model here is at 2% of gross revenue. In cases 1, 2, and 5, we have a straight rate, a flat rate, whereas in 3 and 4, we have a staggered rate or a variable kind of a model based on the gross revenues. So again, we'll have to take that as into consideration. So here, if we see exclusivity, yes, the fifth one is exclusive. Region, Nepal. Period, we are also having a period of about 15 years. Brand visibility, medium visibility, and pricing, we have a flat rate. So the fifth one could be taken as a comparable kind of an agreement. But of course, various other parameters will have to be taken into consideration. Yeah, so benchmarking for royalty, when we look at a cup, we'll have to look at various databases. And what is the list of arrangements that are available online, which has similar kind of parameters. We'll have to carry out a detailed analysis of each comparable agreements. For example, we looked at the different parameters like exclusivity, the region, the period, the pricing model. So we'll have to look at the agreements in detail, and we'll have to identify the arm's length royalty rates based on the search process. Again, these are the factors which was considered in my illustration. You have exclusivity, the life of the brand, the scope, the stage of development of an intangible, enhancement rights, etc. Yeah, that's it. Ganesh, would you like to add something here on cup method when we compare for royalty?
No, I don't have anything to add. I think you've covered it extensively. The challenge with these databases is that the data is very limited. I mean, they do have a lot of agreements, and a lot of agreements are captured, say, from a US standpoint, because a lot of US companies have to report this data. So a lot of these agreements are captured in the database. The question to ask is, when you select comparables, how closely, what are the key factors that would drive the royalty rate? For example, is exclusivity a factor? The fact that the brand is licensing to exclusive to only one person, which means that the royalty rate may actually be higher because I'm the only person who can use that brand. So I will be getting an exclusive right. Whether that is a factor that influences the royalty rate. So if we are able to identify those factors, then the databases would give us agreements. The only other aspect then is we have to go through those agreements for all the terms to ensure that overall the agreements are supportive, are giving us an arm's length answer. The good news is that generally these agreements are long term. They may extend for many years, and therefore if we have these agreements as comparables, if we identify it as one-time exercise, we may not have to do it every year. So for the term that the agreements are valid, you actually would just do this search once, and you will say that the agreement is active for 5 years, so therefore that rate of royalty should be active for 5 years as arm's length. So that's one aspect that you could think of in this case. I don't have anything to add further.
Thanks, Ganesh. With that, we conclude the second topic and we move on to the third one,
Sure.
which is the arm's length of financial transactions. Yeah.
Sure, Hiranmayi. Thanks. And we'll just take a 5-minute break here just for the audience, so that before we get into financial transactions, if we could perhaps assemble back at maybe 6, we are at 6:18 now, so perhaps by 6:30 or maybe 6:25.
6:25.
6:25.
Yeah, 6:25 will be fine then. Yeah, sure. So we'll
Okay,
reassemble
thank
at
you.
6:25. Thank you. Mr. Shetty, shall we begin?
So you start, sir.
All right. Thank you, Divya. Dear members, at this point we will get into more specifically into financial transactions. Essentially, the reason why we're talking about this aspect of transfer pricing is because this is an area which is very unique, and there has been a lot of activity, as we know, in the space of mergers and acquisitions and financial structuring. And there are complex financial products that exist today, which also find a place in multinationals when they are doing deals across countries. So what we'll do in the next, say, 20 minutes is what we have is we would cover some of these aspects. And I'm saying 20 because if we have any questions, we can address it. And leave some time for the rest of the audience. So what we will do in the next 20 minutes is to cover some of the different aspects of financial transactions. And we will examine how typically what kind of methods could be applied for determining the arm's length price. And when we talk about financial transaction, again, we go back to our law, our legal framework, the transfer pricing law, section 92B, for example, which defines international transactions. What are the classified items there with respect to arrangements under financial transactions that are considered to be international transactions? So we'll go into those and we'll give you some glimpses into how the arm's length price is determined for such cases. And then we will be happy to address any questions. Over to you, Faaizah, if you want to start off.
Yes, Ganesh. Thank you, Ganesh. So, as already rightly said by Ganesh, that MNCs are gaining more intra-group are carrying out more intra-group financial arrangements than going out to meet their long-term funding or working capital requirements. So, in this session, we will look into when an overseas enterprise has provided a loan to the Indian entity and the Indian entity paying an interest, whether this transaction is at arm's length or not, or in the case of vice versa. So moving ahead, we would look into how is the arm's length interest determined in a financial arrangement. So next slide. Section 92B. Prior to 2012, there was no clarity whether the intragroup loan or guarantee is an international transaction. However, Finance Act 2012 amended the definition of international transaction to include capital financing with retrospective effect from 1st April 2002. So, what does capital financing include as per the definition is any type of long-term or short-term borrowing, lending or guarantee, purchase or sale of marketable securities, any type of advance payments or deferred payments or receivable or any other debt arising during the course of business. In this, by inclusion of this definition, we could see that the intra-group loan, where it is long-term or short-term borrowing, and guarantee is included as an international transaction, and there is even a case of deferred payment or receivable. So we would be covering typically 3 transactions in this session, that is intra-group loans, guarantees, and trade receivables. Next slide. So how do we determine an arm's length price of a financial transaction? A financial transaction, determining an arm's length price of a financial transaction is very complex. So the guidance note of ICAI provides certain key items to be assessed in financial transactions. For example, we need to look at the nature of the transaction, the purpose for which the transaction has been provided, the duration of the transaction, whether it is for a short period or a longer period, the convenience or the terms of the agreement defining the interest rate or any policies thereof in the intra-group financial arrangement. And the three transactions, the most appropriate method for the three transactions of intra-group loan, for example, would have a cup method or an other method as the most appropriate method. And on the notional interest on delayed receivables, a cup method or other method could be used as the most appropriate method. And in case of a guarantee, that is a corporate guarantee provided with associated enterprises, other method could be used as the most appropriate method.
I'd just add here, Faiza, that I think we've tried to present this in a very simple manner, but I think the key point to note is within a multinational enterprise, there may be complex financial instruments which will be introduced. There may be a debt instrument, there may be a hybrid debt, a quasi-equity, and also that debt may be a debt instrument, but the way the debt instrument is written, it may actually give the lender and share in the equity of the enterprise. So while the instrument looks like a debt instrument, but in substance, it looks like an equity instrument. So we have to be very careful how these instruments are drafted. And there's also there's an interplay between the characterization of the instrument and the tax deductibility of the payment that is made, whether that payment constitutes interest or dividend. So there are those aspects which are very critical for determining the characterization of the instrument itself. What we are focusing on here is the arm's length price alone. So we're assuming here, for example, that a debt is a debt and equity is an equity. So we're not getting into the merits of the instrument per se, but when we look at financial transactions, the complexity arises because of this characterization, whether an instrument is an equity, quasi-equity, or debt. That's something which we need to look at. The other aspect is on when we talk about loans. Loans are fairly clearer because there is a loan by itself is a debt which has a term period and which has an interest rate which is linked to market or for that matter in a prevailing currency. So to that extent, it's not so complex. The complexity arises when there are aspects where there are, say, for example, there's a security against a loan, or there is, for example, a guarantee against a loan. So those are aspects that create a level of complexity in determining the arm's length price. And we'll come to some examples. So is there a discount on the interest rate, on the arm's length interest rate that should be taken for the reason that there is a collateral against the loan? So it's very interesting as a subject for sure, because it gives professionals an opportunity to not just go by an interest rate which is available or published by, say, a nationalized bank, but also go beyond that and say, can I make some adjustments to that third party or independent interest rate to reflect the peculiarities of the transaction within the group? So that's where I think the opportunity for professionals comes in, that how do we establish that arm's length rate is actually an arm's length rate. So I'll pause there. We'll get into some of these aspects in a bit of detail in terms of guarantee and receivables. Faiza, please take over.
Sure, Ganesh. Thank you for sharing your inputs. Now, moving ahead, as rightly said by Ganesh, there could be various intra-group transactions in the form of, in the loan itself, there are, for example, inbound loans and outbound loans. Inbound loans is nothing but where a foreign associated enterprise provides a loan to the Indian entity. And an outbound loan is vice versa, where an Indian entity provides loan to an foreign enterprise. So in such a case, inbound loans are further categorized into non-convertible debentures. There may be compulsory convertible debentures or external commercial borrowings. Each of these transactions would have different currencies or the collateral, the purpose of, and the regulations. For example, in case of non-convertible debentures, we could see that the currency involved is INR because the associated enterprise has provided a loan to the Indian entity in INR. And the purpose of the loan might be due to acquisition or to meet the working capital requirements. All these transactions are already governed under the regulations of RBI, SEBI, or FBI. Moving ahead. How do we benchmark an intergroup loan? We have tried to explain it with an example. For example, the company F company I provides a loan to company F, which is an overseas entity. and company AF pays an interest to company I. In such a case, how do you determine the arm's length price? The benchmarking approach for this would be, we have determined that a cup method would be an most appropriate method in such a case. And we, in this process, would basically estimate the credit rating of the borrower. In this case, company F is the borrower, the standalone credit rating, and we would even identify the third-party debt instruments similar to this company F, like a similar intragroup loans carried out by third parties from the databases available, and try to adjust those interest rates to the uh, terms and conditions of the tested party, that is here the company F. Certain factors to be considered for applying CUP, that is basically what are the adjustments to be made to the interest rates or the filters to be applied to identify the third parties would be the credit rating, the tenure of the loan, the currency of the loan, year in which the loan transaction has taken place. For example, you can't compare a loan that has been taken this year with a very historical transaction of loan carried out in say 2012. So the year of loan transaction is to be taken, the geographic location where the loan has been provided, because each of the region would have different rates prescribed for the interest on loans. So the geographic location and the terms and conditions, because the basis of interest rate also could vary. For example, it could be fixed or floating. So when we have identified the third-party debt instruments from the databases, we need to adjust those interest rates based on the credit rating and all these factors to make it comparable to the tested party. The few of the in case of inbound loans where the currency involved is INR, the tax authorities usually say that the SBI prime lending rate in India could be used as a as a as a comparable based on the credit rating of the borrower to benchmark the intragroup loan. Similarly, in case the currency of the loan is a foreign currency, then the LIBOR plus spread based on the credit rating of the borrower, in this case the for company F, could be used to benchmark an intragroup loan. So this has been basically, as rightly said by Ganesh, this is a simple transaction of intragroup loan, but there might be a complex transaction. So each and every factor needs to be considered before we benchmark the transaction. Just to give an example of what are the different factors that should be considered to determine an arm's length price, we have considered that ABC Incorporation has proposed to invest in the compulsory convertible debentures of XYZ Limited, which is in India. So here, since the here XYZ Limited is the borrower and ABC Inc. is the lender, the INR currency involved is INR, because here the borrower is XYZ Limited. So we see that we should actually carry out a credit rating analysis of XYZ Limited India and then note the terms and conditions. For example, if the tenure of the loan is higher, then it would need that the higher coupon rate should be charged in such a case. And even the security, that is the collateral provided in such a transaction, would have an impact on the interest rate. Where it is unsecured, the interest rate would be higher than in the case where the collateral is guaranteed by a bank. And in case of a moratorium period granted to the associated enterprise, that is, it would have a time value of money. So in such a case, longer moratorium period would actually need a higher coupon rate. And similarly, the other factors could be the conversion option that the lender and the issuer has. Since this is a compulsory convertible debenture, at a later point in time, it would be converted into equity. So we should even cater to those conversion options in this transaction. And the conversion price should be based on the fair market value at the time of conversion. Whether we should even note these factors are considered while determining the arm's length price. Just a snapshot. Yes, Ganesh.
Yeah, I was just adding, Faiza, that see, for the benefit of the audience, this is a very litigative issue also in terms of there's been several rulings around this as to whether a CCD is a debt or an equity, and whether the interest rate that is paid, is it benchmarked at the time of the original transaction, or should it be benchmarked every year? Because this is generally with these instruments, with these loans, these are long-term loans. I mean, it can go up to 5, 7, 10 years. The question that arises is whether you need to benchmark interest rate at every year, because you cannot change the coupon rate every year necessarily. It's an interest rate, it's a tenure that is agreed. So whether you test the interest rate at the time of the transaction, original the borrowing lending that has happened, or do you test it every year? Now this is an issue which has been debated, and there has been a lot of rulings around this. Our view is that if there is no major economic changes around the transaction from when at the time when it was originally entered into, and therefore the question is just to assess that the interest rate has taken into account all the factors that could potentially influence the price of the instrument, then you test the instrument or test the arm's length interest rate, for example, at the beginning of the transaction, monitor it over the year, because the instruments you selected as a comparable would also be valid for that period, hopefully, because those other comparable instruments will also have a longer tenure. So to the extent that is valid, that will help your case. Otherwise, if we see that there is some factor which has caused, for example, there may be a foreign exchange issue, that it's a foreign currency denominated instrument, and for some reason that foreign currency has gone significantly volatile, because of which the underlying interest rate has impacted, then ideally two third parties would renegotiate the underlying currency to say that should the borrower take that liability of the forex fluctuation. So these are aspects that then come into play for renegotiating a loan. But in normal parlance, when you do this benchmarking, if we consider these factors, typically the agreements we also arrive at are long-term period. So therefore, it should help our case in making sure that we are compliant with the law. Yes, Faiza.
We have just given a snapshot of how the interest rates would move in case of when it is a secured, guaranteed, secured, unguaranteed, and unsecured, unguaranteed. The number of comparables identified, and in case it differs based on the tenure, that is 5 years or 10 years, and when there is no moratorium period, 6-month moratorium period and 12-month moratorium period. This is just an illustrative purpose of how the interest rates vary based on each of the factors involved. Like we could see that based on the tenure, the moratorium period, where it is guaranteed or not, the interest rate changes each and every year based on the each and every factor. Yes, Hiranmayi. Now moving on to the issue of trade receivables, whether trade receivables basically arise as a result of the sale transactions that has been carried out with the associated enterprises. For example, when we have actually exported to an associated enterprise, the resulting trade receivable would be it would result into a trade receivable from the associated enterprise. In such a case, we should look into the sale agreement and the terms of agreement that has been entered into. For example, the credit policy that has been allowed to the associated enterprise, the interest, whether an interest has been charged in case where the credit period extends a reasonable period that has been mentioned in the agreement. And so that we understand that the for the normal credit period and the like we need to identify whether the whether the trade receivables have been received within the reasonable period as mentioned in the agreement. In such a case, we note that the working capital requirements of each company would differ between the enterprises. For example, when you are trying to benchmark whether the trade receivables have received within a reasonable period, each company would have different terms of sale. So in such a case, in order to make the independent companies comparable to that of the tested party, we carry out a working capital adjustment. This working capital adjustment is nothing but to adjust the credit risk of the tested party with that of the comparable companies. Working capital adjustment is nothing but an average trade receivables plus average inventories minus average trade payables. This is to ensure that in case the trade receivables are received after an extended period of time, that do not impact the working capital requirements of the entity, because that would lead the entity to borrow from other lenders to meet its working capital requirements. So we check whether the trade receivables are received within a reasonable period as mentioned in the agreement, or there is a extended delay in the receivable of amount from the associated enterprises. So how do we carry out this adjustment would be seen in the next slide. So what we usually do is we carry out this working capital adjustment based on the tested party, and we carry out a similar adjustment to the comparable companies, because only when we carry out a working capital adjustment, it is seen that the terms of sale of each of the tested party and the comparable companies is comparable. Otherwise, for example, as already mentioned, the comparable company might provide on a cash basis, and similar another company would provide to its associated enterprises on a credit basis, and those credit periods would also differ. For example, one company might provide a 60 days credit period and another company would provide a 90 days or 100 days credit period. In such a case, to make the comparable companies and the tested party margins to be comparable, consider the working capital adjustment. Once the working capital adjustment has been carried out, we then compare the adjusted margins to determine whether the arm's length price is within the range. If it is within the range, then we don't have to carry out any adjustment. If it is outside the range, then we carry out a TP adjustment, that is a suo motu adjustment would be carried out by the company on the basis of, since it is outside the range, the median of the comparable companies would be selected as the arm's length price, and the difference between the median of the arm's length price and the actual arm's length price is the TP adjustment that has to be carried out voluntarily by the company. This would not be reported as an interest on delayed trade receivables, because this is due to an adjustment of working capital. So this would be basically reported with the transaction of sale, that is the primary transaction that has resulted into trade receivables. Only when there is an extraordinary delay in collection of receivables, for example, the credit period as per the terms of the agreement state that the credit period is 45 days, and we note that the actual collection of receivable happens at some 120 days. In such a case, it is very evident that there is an extraordinary delay in collection of receivables. So we compute an arm's length interest rate, and such interest on receivables shall be reported under this clause 14. We would further see what clause 14 is about. The interest rate that has to be benchmarked is similar to the interest that has been benchmarked as we have earlier seen in case of intra-group loans. How we compute the arm's length rate for the intra-group loan, it is on the similar basis we benchmark the transaction of extraordinary delay in collection of receivables, the interest on receivables.
So I'll just make it very simple here, and Faaizah, in the interest of time, we'll skip the quiz on this. But the key point is, between group companies, there is always a possibility that one group company is providing a credit period to the other or extending the credit period. Even looking at a COVID situation, for example, where there was a lot of financial distress, we saw arrangements where a group company was delaying the sales revenue to be paid to an Indian entity because they were not getting the money from their customers. So it was natural. Now the question is whether then in a comparable company, they also had a similar situation of bad debts, whether those companies saw, for example, delayed working capital periods So this is an analysis we have to do. It's not automatic necessarily that if there is a delay, there will be a transfer pricing adjustment. We will have to see what's worked in a comparable situation also, whether the comparables have also delayed collecting the money. And then we could assess whether a suo motu adjustment is warranted. But if we have to do that, this is one way to do it, where we do the adjustment considering the impact on profits on account of delayed receivable. So that is one way to address this issue. Then move ahead, Faiza. I think we'll skip the illustration in the interest of time.
Okay, Ganesh. The reporting requirement of the intra-group loans and the interest on such loans is basically required under clause 14 of Form 3CEV, which requires the reporting of the name and address of the associated enterprise with whom the transaction has been entered into, the nature of financing arrangement, basically whether it is an intra-group loan or the interest on such intra-group loan, the repayment of the loan. Each of such transactions are to be reported here, and the currency in which such transaction has taken place, the interest rate that has been paid on such loan, if there is then the amount to be paid or receivable in the transaction as per the books of account as computed by the arm's length price, and the method used for determining the arm's length price. Each of these transactions are to be separately reported under clause 14 of Form 3CEB.
Yeah. So Faiza, can you move to slide 66, please? Yeah. So I'll just take over from here. So the objective was to delve deeper into the concept of guarantee, and which we see often happening within multinational enterprises, where there is, say, in this case, there is an Indian parent and there's a foreign subsidiary, and the foreign subsidiary needs money to run its business, and it has to borrow from the local market, for example, from banks or financial institutions. And because the foreign subsidiary is recently set up, it does not have the necessary assets, or for that matter, visibility of revenues to be able to get the money from the banks. And even if it gets, it will be at a higher interest rate. So the Indian parent offers to the foreign company that I will provide a guarantee to the financial institution, and I'll stand as a guarantor, on the basis of which the bank or the financial institution provides the funding to the foreign subsidiary at a reasonable interest rate, for example. So these are the guarantee arrangements which come within the purview of transfer pricing, because 92B covers these guarantee arrangements as part of the definition. And the question that is always asked is, what is this guarantee? Is it implicit or explicit? By explicit guarantee, you mean, for example, there's a formal letter or a guarantee document that is existing. Say the bank says, and bank gives the loan. There's a loan document between the foreign subsidiary and the bank saying that this is the terms of the agreement, and there it is explicitly stated that this interest rate is provided on the guarantee of the Indian parent. That is an explicit guarantee. Implicit guarantee is where there is no such wording written anywhere, but because of the long-standing relationship that the Indian parent has with the institution has given this loan at a reasonable interest rate to foreign subsidiary. So there is no written letter there, but there is just an implicit support. These are the two forms of guarantee which are generally prevalent. You can move to the next slide. And therefore, the question comes in the same example, if you were to look at it, was the parent helping the child? Or when I say child, I mean the foreign subsidiary. Was the parent helping the child by getting a loan? So is it a duty of the parent to help the child, and therefore it is not a transaction? Or was the parent actually carrying out a transaction by giving the guarantee? And this is the subject of a lot of disputes which have arisen in India with respect to guarantees. Ideally, the tax authorities, what they're expecting is, in such guarantee arrangements or transactions, an explicit guarantee document is most acceptable. Otherwise, it will result in such disputes, because whether it's a parental duty to support the child, or whether the parent is an independent enterprise and the child is an independent enterprise and they should transact at arm's length. That's the debate that has come in. And therefore, in most cases, what is being expected, although there are contrary rulings in India, but going by the recent judicial rulings, the expectation is that there should be a guarantee, a formal guarantee arrangement that is seen between the parent and the subsidiary, and because of which there is a guarantee fee that should flow back to the Indian parent. Can you just move to the next one? And if this was to be the case, then how do we compute the guarantee fee? Now, typically, there is an interest-saving approach that if the foreign subsidiary had borrowed from the bank, it would have got the money at a 15% interest rate, whereas through the guarantee, it is able to get the money at, say, an 8% interest rate. So the 7% is what is the saving that it saves on interest, and that should be going back to the parent as a guarantee fee. This is the most simplest way of saying that this should flow back to the parent, and you will probably exclude some transaction costs or forex, etc. in between. But roughly, this is a rough and ready way of calculating, for which you will also have to evidence what is the rate at which a subsidiary would have got and the parent would have had to pay as a guarantee fee. The other approach is risk of loss, which is if the foreign subsidiary had defaulted in paying the loan, the Indian company would have had to pay the loan and the interest. So what is the possibility or probability of that loss arising? And you then factor the loss and compute the cost of giving the guarantee. That what would have been the liability of the parent in the case of default, and that you, over the term of the instrument, you charge a guarantee fee as a measure of the cost. So that is another way of computing the risk of loss. Of course, there are probabilities associated with it, the probability of default, and that's the calculation one has to do, but that's the other approach that is used in this case. We can move on. So therefore, in summary, there are a lot of guidance on this with respect to financial transactions. Essentially, they say that one has to study the terms of the agreement and characterize the instrument first, and then get into the nature of third-party similar instruments which are available. Compare the terms, because mind you, we are using mostly a cup method, so therefore the exact comparability of the instrument is key. So one has to look at for guarantee of financial transactions, one has to look at it both from the perspective of the borrower and the lender, guarantor as well as the guaranteed. So that's something that is important. The pricing is complex because it is subject to the terms and it's subject to various markets. So we'll have to study the pricing data of financial institutions, markets, and then assess what should be a guarantee fee or an interest rate. One thing you need to bear in mind is often enough in these transactions, the credit rating comes into a play. Mostly with listed companies, there are credit rating available because they will be, there will be published data. But for private companies, that may be difficult. And that is where one has to embark in a different journey if, for example, a credit rating is required. So we may have to get the credit rating done if the transaction is significant. So that's another aspect which becomes complex in such transactions. Let's move on. Yeah, I think we've discussed this, so we can move to the next one. So this is I'm skipping these slides because tomorrow in your session there'll also be the aspects of disclosures in Form 3CB, the precautions to be taken. All of these will be discussed. So in the interest of time, I'm skipping this. We'll just move on. And these are various rulings that are available on interest rates and corporate guarantees. We've just spelled out a few rulings, but I think the more recent rulings of Reddington and Reddington India Madras High Court decision actually has created a situation where a lot of these corporate guarantees are seen to be international transaction with retrospective effect. So this creates a challenge for many Indian parented companies where they've given guarantees in the past. So we need to watch out for these situations. And this is a summary, I think, of all that we've discussed so far on financial transactions, and I'll be happy to address any questions from the participants. Yeah. So on this point on section 94B, because time is short, what the limited point I will say is an arm's length interest rate computation is critical, because often enough the deductibility that we get into for 94B is also dependent on what is an interest rate that is accepted to be at arm's length. So we are seeing interplay between the interest rate computed and 94B. It is also getting becoming important in a situation where you characterize an instrument as debt, but the authorities characterize it as an equity, disallow the interest, and then you have a hit on 94B because you're not getting a deduction because of the interest limitation. So there are these various situations that can arise, but we just thought we'll keep, we'll be aware of this provision that section 94B also has an interplay with transfer pricing. So we should just bear that in mind. So with that, I think in the interest of time, I'll just conclude. These are various reference points that are available, but it is just so that we are all aware of various of these public information that could be used for the purpose of determination of arm's length price. I appreciate the audience has been very patient, has been very interactive, and thank you for that. And I pass it over to you, Mr. Shetty. Thank you for giving us this opportunity.
Thank you very much, Ganesh, Faaizah, and Hiranmayi. We had a fantastic session. So very detailed, and you answered all the queries. In fact, you created quiz also. I think majority of the quiz also answered by our participants. Excellent session we had. Thank you very much. Divya, are you there? Hello, Divya. Divya, are you there? I think we lost her. So thank you very much on behalf of Bangalore branch and on behalf of all the participants. Our wholehearted thanks to CA Ganesh, CA Hiranmayi, and Faaizah. Thank you very much. Wonderful presentation from all of you. Your practical experience you shared. I think we had a great sessions. Thank you very much from the bottom of our heart. And participants, you are the reason. Thank you very much of your active participation. We'll meet tomorrow 4 p.m. Thank you. Thank you very much to all.
Thank you, sir.
Thank you.
Well,
Thank you,
stay
sir.
safe. Thank you.
Good night.
Once again, thank you, sir, Ganesh sir, Hiranmayi madam, and Faaizah madam. Thank you so much.
Thank you. Thank you. Thank you, Divya.
Thank you. Thank you.